could spur a little bit of a reversal, particularly in the 5-year area of the yield curve.
This actually was something that Mary Daly of the San Francisco Fed really went over in that Financial Times article that John was talking about how the stop-start policy of the Federal Reserve is something that's really important to avoid, for them to be on hold or even cut and then have to hike again, and that there's this real concern that people don't understand how much economic heft there is right now in the United States. Do you agree with that view, that right now people are overly optimistic about rate cuts, and that frankly it becomes more dangerous as we do take a look at some really solid fundamentals?
Yeah, absolutely. So on the first point, I think there's as much sort of Fed psychology, Fed Kremlinology, if you will, as economic information that we need to go over. So one of the key things that the Powell Fed views the mistake of the 1970s was essentially declaring victory on inflation too early. Right? And so the easy response to avoid that happening again, though the circumstances are vastly, vastly different, but the easy response to keep that from happening again is frankly not to declare victory almost at all. And in that world in which the Fed is very hesitant to declare victory over inflation, it's hard to imagine rate cuts are forthcoming unless there's material economic downside, which we don't put it better than a 50-50 chance for mid-2024.
What do you see for 2024 on total return, coupon plus a gain versus just clip the coupon? I mean, how does that work out for you?
Well, so our concern really is higher longer-term rates, 10-year and out area of the yield curve that's correlated with a period of unusually strong economic growth. So that would portend negative returns possibly, or very low returns in the long end of the curve. We haven't sharpened our pencils for the 2024 outlook yet. It's going to be a few weeks away, but I'll be sure to send you
Stop. I'd wait for December 27th for that.
Oh, okay.
I mean,
one of the purists.
Slide into that. I look at it, Guy, as an impossible task. What does retail do here? What do people, they don't want to be in stocks. I'm not buying Amazon. I'm not buying Walmart. I need yield. So what is it just a laddered approach is the only way to go now?
Yes, so we've advocated as a strategy group for barbell portfolios for the last little while. A substantial amount of holdings on the front end of the yield curve inside of 2 years, relatively little in the belly, and a little bit more on the 7 to 10-year area of the yield curve. And we don't, as advisors, go out much further than 10 years. But that barbell really allows for, in the case that economic growth does remain unusually strong for an extended period, it allows a lot of dry powder on the front end of the yield curves, bonds that are going to be coming due in the next year, next 2 years, to be able to deploy a little bit further out, if indeed we do get that higher yields and stronger extended economic growth.
Guy, thank you, sir, for the update. Looking forward to the outlook for 2024. Guy Levant of Janney Montgomery Scott. Just look at treasuries over the last 3 days or so. On Tuesday, coming off the back of that CPI report, we had a move of almost 20 basis points lower. In yesterday's session, we were almost 10 basis points higher. And this morning, Lisa, we're about 4 basis points lower again. What's normal in this bond market now?
It's a great question.
What is it?
I mean, basically the fact that we're going up and down on different days is probably more normal than just having one moonshot up. That's the normal people are hoping for. But it's a great question. And how much is this due to a lack of liquidity and positioning and, end of market dynamic, end of year dynamics, not end of market. Maybe that's just how
although
people
you called
feel.
for that.
End of days dynamic, Ramo.
I know, I've seen that. I've seen people, putting me in The Simpsons with that, end of days. They're coming here. Definitely.
Yeah.
That's something I can
A week
relate
ago
to.
this morning, the 10-year yield opened at about 4.48. Given everything that's happened in the last week or so, the 10-year right now is 4.49. Just to get your head around some of the volatility. It's been like a flat market for a week. It doesn't feel like that.
No, it doesn't.
At all. From New York City this morning, good morning.
The EU is one of the largest and wealthiest consumer markets in the world, and there are very few global companies that can afford not to trade in the EU. So as the price for accessing the European market, these companies need to obey European regulations. That's not surprising. But often these companies choose that they will extend the European standards across their global conduct and their global production because they want to avoid the cost of complying with multiple different regulatory regimes. So there are benefits to standardization, benefits to uniform production. So all the EU needs to do is to regulate the single market. And it's then the market forces and the business incentives of global companies that transform that EU rule.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
The United States will continue to compete vigorously with the PRC, but will manage that competition responsibly so it doesn't veer into conflict or accidental conflict. And where it's possible, where our interests coincide, we're going to work together like we did on fentanyl.
The President of the United States speaking to the press after meeting with China's President Xi Jinping for several hours. We're in a competitive relationship, China and the United States. It's about managing this competition going forward from here. Said this a few times over the last couple of days, just reaching for the thermostat and just taking down the heat, TK. That's what this was all about, on top of a charm offensive coming from the Chinese leader with corporate America.
Exactly. As you mentioned, the commercial nature of this, I think, we can't say enough about it. We always do surveillance corrections here when we bomb out. I bombed out this morning. I conflated China in Vietnam. China propaganda is what Variety said. Margot emails in from Hollywood early in the morning. Margot, thank you for listening. Really appreciate you watching Bloomberg surveillance. Margot makes clear it was
Can we not call these surveillance corrections? Can we just go with like a banner that says Tom is wrong?
Tom is wrong. Well, we've done that for years.
Do we all have to sync with you?
No, you don't. It was my folks' spot.
It feels personal.
Vietnam was offended over the 9-dash around the South China Sea.
Gotcha. I remember that now, yeah.
Vietnam was offended.
Neither of you guys saw Barbie. I actually saw Barbie. Just want to put that on the table.
No,
He's watched Barbie.
You have?
Of course he has.
Of course.
Streams it now. Every night.
Let's move on.
I will watch it.
I think it's actually a really interesting.
I'll give you the review.
I'm looking forward. I'm very much looking forward to that.
Marco's watching the show. That's the headline.
Is Marco actually watching the show?
Yes, watching the show.
Very cool.
Thanks for watching.
Okay.
Early morning LA.
Equities at the moment on the S&P, slightly negative. That's not true. We're down about 1/10%. Might be true. Who knows? We're down about 4 basis points on a 10-year. 449.21. And foreign exchange doing absolutely nothing on the euro, Tom. 108.49.
It's going to be interesting to see. We'll watch the data here. And, of course, an economic event today. That would be Walmart's earnings. We'll go beneath the headline data. Right now, on these important meetings, we're making jokes about it. Come on, this is important. Michael Herson joins us, head of China research at 22V Research. Michael, thank you so much for briefing us this morning. What was the unexpected that you saw last night besides a dictator faux pas by the president late? What was the unexpected of the meeting?
Nothing too unexpected, frankly, which I think is good. Maybe the Chinese readout perhaps was a bit more positive than I was expecting, and that really reflects what has been a bit of a, a recalibration in China's official tone towards the U.S. over the last few weeks. But other than that, I would say no big surprises.
Okay, no big surprises. Great. What's next? When's the next meeting? Does the president travel to China to make it to?
Well, I think that's actually a really important point, Tom, because this is basically the last high-profile meeting that the two leaders are going to have before the next U.S. presidential election. So this kind of sets the parameters for the next year. And those parameters really are trying to find stability, not allowing a crisis to take place over something like Taiwan, and then just making incremental progress on some of the key issues in the relationship. But if you think about it, the closer we get to the US presidential election, the harder it will be for Biden to do anything that's seen as being soft on China. And of course, why would Xi Jinping make concessions to the US when he doesn't know who the next president will be? So I think that's where we are. That's why this was kind of an important window for the two leaders to meet.
Did the dictator comment mean anything to you?
Not really. I don't want to dismiss it entirely. I think it probably was perhaps not the positive tone to go out on. But I think in the grand scheme, given how much work both sides did to try to make this meeting happen, I don't think it's going to color too much on the Chinese side.
What did you make of the meetings that Xi Jinping had with U.S. executives, Apple's Tim Cook, for example, a whole host of others, and then a private meeting with Elon Musk? What's your takeaway of how different the business view on China is from the U.S. government's view on that country?
I think there are a few very prominent U.S. firms that have this special position in China, and that I would put Apple and Tesla very much as the two bellwethers in that category. They have managed this straddle between the US and China. It's not an easy straddle on either side, but they're in kind of a special category. If you look at the broader set of US firms in China, it's really a mix between those who feel like they have a decent market in China and those who are really upset about China's policies. And so I would put Tesla and Apple in this kind of special category. And so it's no surprise that they got some special attention from Xi Jinping.
Do you have a sense of who needs who more? Of whether Tesla and Apple need China more than China needs them and the jobs that they provide?
It's an interesting question. I would say for the companies, they need China more. But if we're talking about Apple and Tesla, they are very important bellwethers for how the business community looks at the playing field in China, and not just the US business community. That's Europeans, Japanese, global companies in China, which is why I think Beijing actually has to tread very carefully with things like, for example, potential retaliation against Apple. So yeah, the companies need China more, but these are quite important as Xi Jinping looks to try to revive confidence in China's economy and China's investment environment.
Michael, a question we haven't brought up yet, I've been remiss on this. Is Hong Kong going to evolve into something that we don't see right now? Is there a Hearst Hong Kong out there that's going to be different?
I think Hong Kong really, and I was just there last week, is in this somewhat gradual transition from a global hub to really more of a pure capital gateway to China, and is increasingly becoming more of a Chinese city. That is still an interesting position for it to play. And a number of China watchers that I've had discussions with recently have made the point that they think Hong Kong is going to remain an interesting city as the political environment in China stays very tight and in some cases even tightens further. So Hong Kong losing its status as a global financial center, but still quite an important city in the context of, in particular, in context of China.
So what's the alternative for those people whining and dining with Mr. Xi last night? What city do they go to?
I think if we're talking about the financial sector, it's a number of places. Singapore obviously has gained a step. Even Tokyo has become more important as a regional financial center. If we're talking about the multinationals, it's wherever they can get capacity and wherever they can get the logistics right. So in many cases, as you mentioned Vietnam earlier, Vietnam is a prime beneficiary, but it's also Mexico. It's a lot of countries.
Michael, we've got to leave it there. Thanks for being with us. Michael Herson there of 22V Research. Thank you very much. These changes, Bramo, are already happening. This is the problem. It comes from both sides. It's not just about the relationship and what the United States is responsible for. The lack of clarity and visibility on predictable policy coming out of China over the last couple of years has been really difficult. I mentioned it a little bit earlier this morning. I'll reword some of the things I said. If you're making an investment today in China, can you be sure the rules will be the same tomorrow? And that's the difficulty that some of those leaders of businesses, corporate America, have got right now with investing in that country.
Which is the reason why you saw foreign direct investment, or at least part of it, actually fell negative in the most recent data in China for the first time going back in data to 1998. What Michael Hurston just said there, that was fascinating about why China is so determined to maintain a relationship with both Apple and Tesla. Not because they need them more and the jobs, but because they set the tone for global corporations as a way that global companies can do business in China, which raises this question, okay, in this dance, what does that mean? What does it evolve to, and how much can it serve as a template for other companies that are forming their businesses in very different ways without that manufacturing heft?
They're the heart of the goods, the unit manufacturer psychology of China, which has been there for decades. What do we do in finance? I mean, you mentioned Lawrence Fick was there. What does BlackRock do with China?
What does Blackstone do?
What does JP Morgan do? What does Blackstone do? Yeah.
Ray Dalio, Bridgewater, was also around a table as well.
Yeah, he probably gave you a copy of his book, Principles. Yeah.
Is that right? Is that what he does?
Yeah,
distributes books everywhere he goes.
Yeah,
even to dinners like that.
Can we do another surveillance correction? Are you going to Las Vegas? I know you were looking at pit tickets. It's upon us.
We're going to be talking about prices in the next hour to attend and to stay in Las Vegas this weekend, and those prices have been absolutely slashed.
Down.
Ooh,
Yeah. Surveillance correction. That's what we're doing this hour. Surveillance correction. Warmer in Las Vegas for John Farrow this weekend. 47 degrees, not the gloom of 41 degrees. 8 degrees Celsius. We convert that.
Maybe those tires will actually get up to temperature and we can have a decent race this weekend. We'll see. Coming up next, Wei Li of BlackRock on this market after a stellar week of gains we've seen over the last couple of days. Really all about Tuesday. Just a monster day of gains off the back of a small downside surprise on CPI. Equity futures this morning, just about unchanged from New York. Good morning.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Today, I would say perhaps only second to AI right now, which is AI has got so much going on and folks are so excited about it. Climate tech is the hottest area to be in.
Keeping the faith in billionaire Warren Buffett. The legendary investor turns 93 this August. His signature must-read letters to shareholders have been getting shorter and shorter. This year's letter contained few fresh ideas. But most investors in a Bloomberg survey say Buffett's steady Eddie approach of buying cheap, safe, high-quality companies will beat the market. They expect returns in his investment company, Berkshire Hathaway, to outperform the S&P 500 over the next 5 years, adding to an incredible run in which Berkshire shares have returned more than 3,000,000% in the almost 6 decades Buffett has led the firm. Investors are also willing to pay up for Berkshire, which owns everything from the railroad BNSF and car insurer Geico to See's Candies and Coca-Cola. About 1/5 quantify the Buffett premium at more than 10% of Berkshire's stock price. More than a quarter say it's somewhere between 5 to 10%. There is one problem for Berkshire Hathaway, its size. Thanks to a bunch of cash-generating insurance companies, Berkshire has at least $130 billion in cash that it can put to work. But it needs big acquisitions to move the needle. Buffett calls it hunting for elephants. And we know Buffett hates overpaying. So that means sitting tight, patiently waiting for the right moment to pounce on the right company, which might be a drag on performance for now, but as Buffett fans know, usually works out in the long run.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals. our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority.
Consumers are still spending. And on top of that, you're getting some relief on the pricing side.
If they continue to spend and add to their debt levels, that could slow things down.
The trajectory over the longer run is that inflation should start to gradually decline over the coming months.
That resilient growth story can run. I don't think a recessionary threat is immediate.
I think we will slow, but I don't think this is an economy that's at any imminent threat of anything really bad happening.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Lots of retailers reporting earnings this morning. Live from New York City. Good morning. Good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Your equity market on the S&P 500, totally unchanged. This morning is all about the retailers, TK. Walmart is about to drop any second now. Just hearing from Macy's. Even good news coming out of Macy's, Tom. Entering the holiday period in a healthy inventory position. We'll take that.
Yeah,
we'll take that.
We'll take that. That's exactly right. For day trading Macy's, it's good. I'm looking at 70 to 5, and now it's back up to 12 with a nice lift today to 13. There's two different types, as you mentioned earlier, John, two different types of retail as there is in every other sector. People nailing it. Maybe we'll see that from Walmart, and people really challenged like Macy's.
Walmart just dropping, Tom. I'll go through the numbers for the third quarter. Lisa can give you the outlook. For revenue for the third quarter, it is a tiny, you would say teens winks, BTK on revenue. Same thing on EPS. Bramo, the outlook far more important. What do you see?
It's just slightly better. Again, all these slight beats in Walmart, which is maybe why you're seeing the shares not pop. Full year adjusted earnings per share expected to be $6.40 to $6.48. They'd previously seen $6.36 to $6.46. Basically, this is not much of a difference. So for people looking for a massive outperform signal, not necessarily getting it, but this stock has been up so much more than all the other retail stocks so far this year.
Well, I think you nailed it. It's relative to what you were looking for going into the numbers. If you were looking for an aggressive slowdown in the US consumer going into 4Q in the holiday season, Lisa, looking at Target, looking at Walmart this morning, and I need to go through some of the details with a little bit more of a closer look, but ultimately, you don't see it, do you? You don't see this drastic slowdown people worried about.
You raise a great point, which is that basically how much were people actually looking for a slowdown? How much are people actually pessimistic on the U.S. economy versus banking on this soft landing and continued acceleration? And that's why you're seeing some of these slight beats actually punished in the market for a name that already has a lot of expectation built into it.
I fault them. They report pre-currency adjustment, and they got a 5.2% revenue pop. Okay, mid-single digit, but in constant currency, they slice that right away to 4.3%. So, the market will have to see how that is. The answer is you got a single-digit revenue growth with dominance, with market leverage, and it's trading at a 30 multiple. I'll let you explain that to me, John. I just flat out don't get it.
Stock is down a little more than 2% in the pre-market. That's Walmart. Macy's is higher by about 4.5% following a massive day of gains yesterday for Target. More on the retailers in just a moment. Let's turn to the broader price action on the S&P 500. Equity futures shaping up as follows. We're just about unchanged on the S&P, not doing much at all. Yields are coming in 4 basis points, but let's face it, the bond market's been all over the place over the previous 3 days. On Tuesday, we had a 20 basis point move lower. Yesterday, almost 10 basis points higher. And this morning, Lisa, we're down another 4 or 5 basis points to, let's call it 450.
So maybe we don't have such a clear narrative after all, and we'll be sort of juggling around with others for the rest of the year. What we're watching is we did get the retailers that we just were talking about, Walmart and Macy's. We are going to be getting after the bell Ross Stores and the Gap. How much do we see this sort of reaction in markets that if you don't see some sort of massive outperform or jumping over a low hurdle, how much do you see that punished? And I actually think that's interesting to signal where sentiment is. 8:30 a.m. we get U.S. initial jobless claims, key indicator of whether the softness continues. especially given that it has been very slight and yet notable. The trend matters. We will be checking that out. And today, Fed speakers will come out and say that they're not going to declare victory. They're also going to say it's too early to tell anything, and they're lined up to give us that insight. Fed Vice Chair for Supervision Michael Barr, Cleveland Fed President Loretta Mester, New York Fed President John Williams, Fed Governor Chris Waller, and Fed Governor Lisa Cook at a time of great uncertainty, and they cannot add much clarity because they do not have a crystal ball.
And if they do declare victory, what happens?
Exactly.
Markets absolutely rip. And then we sit here and say, why did they do that?
Exactly.
The market's working against what they want to achieve. And then we'll sit here and complain. So they're trying to say nothing. But truly, if you want to say nothing, don't say anything at all, which would be my advice. Don't schedule the speech. Talk.
Okay, if you have something to say, talk. There sometimes are interesting insights. If you don't, is it just becoming noise? I don't know. I can't really argue against over-communication because we get to talk about it every day, and I get to put it in my look ahead for the day, and I enjoy talking about it.
Say, right?
Exactly.
Okay.
Walmart comp sales U.S. up 5%, e-commerce up 24%. That's a wow statistic.
There was a sharper fall off in sales during the last 2 weeks of October.
Yeah.
That's the line coming from the Walmart CFO. Tom, I think that's an important line. What's in store for 4Q? Let's talk to Wei Li, Global Chief Investment Strategist over at BlackRock. Wei, good morning.
Good morning. Happy to be here.
Disinflation, tons of it. Is the economic slowdown next?
Well, what we have seen so far this year is really the unwind of pandemic mismatch. So that has brought inflation down, but also growth is coming out of the hole that has been created by the pandemic, right? So really normalization in a way, just kind of unwinding pandemic mismatches. So is growth going to slow down? Yes, I think so, because we have had the fastest rate hike cycle since the 80s, and it's going to act on growth with a bit of a lag, but we're likely going to see kind of rolling growth slowdown in different parts of the economy that is going to, on aggregate, feel not too bad, right? So we're looking at 0.5% growth for 2024. So that's not too good, but we're not talking about deep recession. And consumers have been strong. They find $1 trillion additional dollar on their balance sheet that has been propping up sentiment. So really a environment that actually, as we compare that versus beginning of the year, a case can be made about putting some of the cash to work that has been sitting on the sideline.
Well, we can talk about where to put that cash to work. This is coming from the CFO over at Walmart. We are more cautious on the consumer than we were 90 days ago at this time. More cautious on the consumer than we were 90 days ago. That's a change. Whereas you're thinking about putting money to work, is it towards consumer discretionary? What is it towards?
Well, it depends on what's been priced in by market. So far, if you look at U.S. equity market, 17% up for S&P 500, but the mega tech names still account for close to 90% of that performance. Equal weighted S&P is still flat on the year. And if you look at multiples, actually 72% of the U.S. equity market are trading at multiples lower versus the pre-pandemic level. So there's a huge amount of dispersion, and I think dispersion is how we would think about putting cash to work rather than indiscriminately buying into the broader market just because the growth and the inflation story versus beginning of the year.
This basically is giving voice to the fact that Macy's is rallying today and Walmart is selling off. I mean, isn't that basically an articulation of everything you said? Even if the consumer slows down, Macy's has priced it in. Walmart hasn't.
Dispersion among sectors and also dispersion within sectors. We're focusing on companies that are able to grow their revenue, they're able to keep up their margin even in this growth slowdown type of environment. So the time for being selective and alpha focused is really here.
There's a bigger question here, which is where is the balance of risks in terms of market participants' eyes? Is it that the economy reaccelerates and that the Fed has to do more? Or is it the opposite, that we get a significant slowdown that people are still cautious around? It feels like it might be that people are more concerned about an overacceleration at this point rather than the recession that people are exhausted of even thinking about still.
I think at this very juncture, on this very day, maybe that is true, but it's incredible how quickly narratives have been shifting. I mean, we're talking about 10-year moving 20 basis points in response to a monthly data print, right? Like, it's incredible how long-term kind of measures are reacting so sensitively to short-term data print. So I would say, yes, right now at this juncture, maybe, but, you know, give it a day or two, that risks can shift very quickly. As we look ahead to next year, I think it's really focused and boiling down to what's in the price and not be carried away with the daily noise of, you know, what's the narrative of the day, what's the narrative of the hour.
Your claim in mathematics in your China, and then to Cambridge, and now leading the working group on China at BlackRock. Your thoughts on what we've observed in the last 24 hours, and particularly your thoughts on the embedded bipartisan distrust that America has for Chinese leadership?
Well, what we have seen the last 24 hours maybe is putting a tentative floor and re-establishing communication channels, and I think that actually has been much needed. They're speaking for the first time in a year. I would also say that we're talking about just kind of putting a floor and just tactical pause in terms of the geopolitical focus, because, you know, if you think about the upside, so far what's come out is kind of establishing conversations around AI risk, fentanyl, and broader communication channel. But what really matters for the economy is tech. What really matters for the economy is broader kind of engagement, and we have yet to see that.
This nation was riveted from a balloon from Montana off the Carolinas this year. I don't want you to speak for Mr. Fink. That's inappropriate, the leader of BlackRock. But what are your thoughts on the meeting of commercial America with President Xi for dinner last night?
I think commercial America are involved in the conversation, a part of the conversation, in order to stay informed on issues that they can then really represent and conduct on behalf of their clients, in the same way that we're doing that on behalf of our clients as well. We need to be staying on top of the issues so as to act in the best interest of what we represent. And the broader picture coming out of China is growth is starting to stabilize in response to incremental easing, but sentiment is still really negative. You talk about China, you speak to investors, you speak to strategists, sentiments are still quite negative. Market dynamics is still quite negative, and it takes a lot for consumers to kind of really embrace the reopening in the Chinese economy the way that we have seen in the US.
It's been a big disappointment this year, the underperformance of China's economy relative to the outperformance of the US economy. We were coming into 2023 talking about US recession and a monster reopening of China, and it's just been the other way around. Wei, thank you. It's good to see you. Always is. Wei Li of BlackRock. If you are just joining us, welcome to the program. Equity markets pulling back just a touch on the S&P 500. We're negative here by 0.17%. That's the equity story. Let's get to Walmart. Walmart in the pre-market looks like this. I want to pick out one single name. We're down by more than 4% to 162.75. The numbers, not terrible. Modestly raising the annual profit forecast, but the tone on the outlook, just the commentary around it from the CFO in an interview saying the following: on a sharper fall off in sales in the last 2 weeks of October, saying this, TK, we're more cautious on the consumer than we were 90 days ago. More cautious on the consumer than we were 90 days ago. This is the fear right now in equities, and I know we've had a big move this week. We've been talking about the happy talk of the last couple of days. You've had the disinflation. Is the slowdown next? I think that's the ultimate fear still, Tom. And the other one I'd throw in there as well, and we've repeated this line through the year so far, is the economist who cried recession. They've said it so many times through 2023 that I think a lot of people are beginning to ignore it. So it's surprising when you start to hear it from corporate America.
We forget that retail's quoted typically in nominal terms, and you've got to believe nominal GDP is going to come in. You have disinflation, if you believe in that, or even a resilient 3% inflation. And then what does the real economy do? And if you get both of those, John, coming down in different ways, but coming down, you get a dampened nominal GDP, and that goes right to Walmart's revenue line, where and these are small moves, but they're huge. For them to go from 5% to 4% modeling of revenue growth is game changing.
I want to go through all of the line items. I want to understand where the gains came and where the losses really came into play here. If the gains came from shoppers looking for groceries that are lower priced ahead of the holidays, is that a good signal for the U.S. economy, or is that a negative signal for the U.S. economy?
I often ask the same question. The stock is down by about 4%. Equity futures are doing okay. We're pulling back a touch. We're down by about 0.2% there. Coming up shortly, Michael O'Rourke, Chief Market Strategist at Jones Trading. We'll catch up with him in the next hour from New York City. This is Bloomberg.
Lots happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions. That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio. This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month.
While the Fed's been tightening a lot, the underlying health of the private sector, both households and businesses, remain quite strong. So I think we will slow, but I don't think this is an economy that's at any imminent threat of anything really bad happening. I think the Fed is going to be patient here, but I don't think this is a victory, and I don't think we're going to be giving the Fed room to ease off the inflation numbers anytime soon.
We've heard that so many times this week. That was Bruce Kasman at JP Morgan, heading up the global economic research team, that ultimately this market is itching to declare victory in the fight against inflation. Fed officials do not want to go there at all. We saw that from Mary Daly of the San Francisco Fed. Speaking to Colby Smith in the Financial Times yesterday, she almost said it, Tom. We don't want to declare victory. On the economic slowdown that may develop in the coming quarters, let's look at two retailers, one Macy's, two Walmart. And the difference between these two right now is one company saying all the right things and the other one saying all the wrong things. Macy's beating on profits. Inventory, that story's better. That stock is up by close to 12%. Walmart's down 4%. The numbers weren't terrible. The outlook wasn't too bad. They inched up the outlook just a touch. But the commentary from the CFO, I have to say, kind of dreadful. Talking about a sharper fall-off in sales during the last 2 weeks of October. And I keep going back to this line, Lisa. More cautious on the consumer than we were 90 days ago.
That's exactly what stuck out to me, this idea of a quickly deteriorating picture at a time when everyone is wondering, is there going to be another shoe to drop? And I think that's the key, right? Are we getting that slowdown in real time in a new way? And they're referring to that.
And as we hear from those companies, stocks are pulling back. On the S&P 500, we're down about 0.2%. The cross-asset picture looks a little something like this. Yields are pulling back by about 3 basis points. Let's call it 450 on a 10-year, and hopefully we can get some stability in today's session. We have this warning, though, from the former New York Fed President Bill Dudley, saying U.S. authorities need to act before the safe haven of the Treasury market becomes a source of instability. Here's the quote: ideally, the government would do its part by getting its fiscal policy in order. Unfortunately, Congress appears unlikely to do so anytime soon unless the bond market vigilantes return in enough force to compel a constructive response. Mike McKee joins us around the table, economics and policy correspondent. Mike, you've heard that warning from New York Fed President, former New York Fed President Bill Dudley. What do you make of it?
Well, he's absolutely right. It doesn't look like Congress is going to do anything. There's a really interesting piece out by Karen Dinan, who was the former Treasury Department chief economist now at Harvard. It shows the expected path of debt, the chart she has. I didn't bring it since we're on radio here, but basically we're at a point where we were last in the 1940s after World War II. And from here, it's almost a hockey stick up. And so obviously there are problems in the future. What Bill Dudley is talking about is somebody's got to buy all the debt we're going to sell. And because of various regulations, it's hard for primary dealers to absorb that amount of debt onto their balance sheet. So he has a couple of different ideas on how you could make the system work to make it safer, including giving the primary dealers some ways around the restrictions on what they can hold, have them be agents, and then make the Fed's repo system all worthwhile, work for everybody, rather than just the primary dealers and agents.
Let's frame that out with someone that has the experience on this. At the New York Federal Reserve, William Dudley joins us now, former New York Fed president, Bloomberg opinion columnist. Bill, you and I'm going to suggest Professor Williams, now holding court in the former Dudley chair, have a unique perspective on our flows, our liquidity, our trust. Sitting at the New York Fed, what is the confidence or trust deterioration you've observed?
I think there is complete trust in the New York Fed because the Fed basically understands the plumbing of the financial system and understands what needs to be done to make sure that plumbing works always, even under times of stress. One area of vulnerability where the Fed and the Treasury are looking at right now is the Treasury market itself, because the volume of Treasury borrowing has gone up dramatically, and the capacity of the primary dealers to take on that burden has diminished because of all the regulation on capital and leverage. So there do need to be some significant changes, I think, to the Treasury market to make it more strong and resilient. And what I propose is a couple things. One, central clearing of Treasuries, so they all go through a central counterparty. So your risk is just to the central counterparty. Allows you to net down a lot of bilateral risk to a single risk to one end person. Second, increase the leverage, the haircuts a bit, so that they don't need to be increased during times of stress. Right now, you have low haircuts, and then there's stress, and the haircuts go up, which force people to sell. And the last thing, which Mike was talking about, is opening up the Fed's repo facility more broadly, making it so that people can take treasuries and turn them into cash at any time. And if they know that, then they don't actually have to sell the treasuries, in anticipation of a problem. They can wait to see if they actually need the cash.
Bill, if none of that gets done, do you think the action we've seen and what you expect compromises the QT program coming out of the Fed?
No, I don't think so. I mean, I think the QT program basically is on autopilot as long as there isn't a lot of market disruption. So if the market performs reasonably well, then QT keeps going. Only if we have the kind of events like we had in September 2019 or March 2020 when you see QT suspended. Because if the market isn't working right, the last thing the Fed wants to do is dump more securities into the marketplace.
What's at stake here, Bill, if there isn't this sort of fix that you propose, or this three-pronged proposal? How much are we seeing what sort of the new normal looks like with bouncing around 20 basis points on a 10-year yield from day to day versus something more significant that creates a real crisis in the world's deepest and most liquid market?
Yeah, I think the volatility we've seen this year is not a Treasury market function problem. I think the volatility we've seen this year is people trying to figure out what's the trajectory of short-term rates over the next 6 to 12 months. And there's been lots of changes in view as the economic data has come out. I think the problem is more when all of a sudden people want to dump Treasuries, and there's not enough capacity on the other side to absorb that. That has happened a few times, and obviously it needs a catalyst, and it's hard to predict what that catalyst could be. But what I want is a Treasury market that can handle those kind of shocks if and when they occur.
Are you saying that right now there is an inability? What do you expect will happen if there is some sort of catalyst?
Well, if there is some sarcasm, one of the problems, a lot of the treasury trading is handled by algorithmic traders who basically don't really provide long-term liquidity to the market. They just provide liquidity for a microsecond, and then they move that security off to someone else. And when things get scary, they completely withdraw from the market. And then the market is really now then has to go to the primary dealer community. But the primary dealer community hasn't allocated capital to this business because most of the time they're actually not doing it. So there's no one there at sort of in extremis provide balance sheet capacity to sort of calm the market. And that's one reason why you'd like to have the ability to take your treasury securities to the Fed and turn them into cash without actually having to sell them. So the Treasury is the only one, the Fed is the only one who has a balance sheet that is actually elastic. So why not make it clear that that elastic balance sheet is available on an ex-ante basis as opposed to only ex-post after they've actually had the problem?
Bill, how does our data dependency look next year? I think we've had a celebration of disinflation in place. Is the nature or character of the Fed's data dependency different now and forward?
Well, I think they're more confident that they've, moved monetary policy to a restrictive level, and it's actually working to bring down inflation. But we still don't know a lot of things. We don't really know how tight monetary policy is. We don't know how long it's going to take to get inflation down to 2%. So I think the degree of uncertainty and risk is a lot less today than it was, say, 18 months ago when the Fed started the tightening process. But there's still a lot of uncertainty about how strong the economy can be and whether the Fed is done.
What a roller coaster ride this bond market's been on over the last few months. Bill, wonderful to catch up with you, sir. Always is. Former New York Fed President Bill Dudley there. An interesting, thought-provoking piece from Bill on the future of this Treasury market. Let's just return to one single name in the pre-market. It is Walmart. Session lows. It is down, and down hard by close to 6% now, Lisa. Cautious outlook on the U.S. consumer going into year-end.
And as you noted, more cautious over the past 90 days, which highlights the immediacy of some of this downturn. It should be noted that Walmart shares were near record highs coming from this. So how much is this a valuation question? But the larger macro question that I think we're getting some hints of in these earnings is the consumers are not recklessly spending in any way, shape, or form. It is a new form of spending.
Stock is down more than 6%. Coming up shortly, George Concavos of MUFG to weigh in on this bond market, some of the recent economic data, and we might get a comment as well on some of the moves we're seeing from the retailers in America. That's still to come from New York City. Good morning.
Sports and money. They've always gone together.
But
but never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona,
to the kabaddi tournaments in India,
to the cornhole boards at your local tailgate. This is what's next in sports.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
Your equity market pulling back right now on the S&P 500 down by 0.2%. Walmart session lows down about 6%. The numbers from them weren't bad. But the commentary about maybe a deceleration in sales going into year end, I think, has caught everyone's eye. Sam Rowe out on Twitter, just one of my favorites. This is great. Walmart's Q3 was strong, which is bad because it must mean consumers are trading down. But Walmart's sales fell off in October, which is bad because the consumer must be doing really bad. But Walmart sales picked up in November. No way that's good. That's the latest from Sam Rowe this morning, Tom. Yeah. If you're following, it's like, it doesn't matter what the numbers are at Walmart. It's bad. Stock is down 8%.
Major pet peeve, John, I have, and you know I talk about the big banks and we don't understand their dominance, is in retail, we conflate the Macy's Day Parade as being as dominant as what's going on in Bentonville. The market cap of 3 retail names that I conflate into one, I'm as wrong, and this is anyone. Walmart, $500 billion. Target, under $100 billion. Macy's is minuscule.
Yeah, barely exists, right?
On market cap.
I know.
Nobody talks about this except Bloomberg surveillance.
Thank you, Tom. And Tom King.
I think it's terrible. We conflate all these names together, and the pros like George Gonzalez
well, I don't think we do. I mean, to be fair, I don't think we do. I don't think anyone compares Macy's to Walmart.
But in the same breath, we're like the Thanksgiving parade, and Bramwell goes to where they
You're the only
blow
one that's
up
talked about a parade.
Balloons.
I remember we went to the parade once.
Remember
together.
how they ruined the balloons? You could go right up to the balloons and literally touch them. Take your 4-year-old, touch the balloons.
Touch the balloons?
Yeah.
You could actually
when they
like,
blow
walk
them
onto
up,
the
go
road?
right up
when they're blowing them up.
Blowing them up
the night
night
before.
You have a beverage in your hand.
But it's so crowded that it's very hard to do that. You have to,
I remember we did the parade together. That was fun.
We did.
Yeah, that was good.
That's so sweet.
Back when we were on speaking terms.
When we used to spend Thanksgiving together.
Yeah, you know,
You
now.
came to one of those.
Yes,
right? Yeah,
it was
good.
lovely.
We didn't do the parade together, though. It was a beautiful thing.
Because
when we all liked each other. We
It's
went for breakfast the other day.
great.
We went for breakfast the other day, and this table of women came up to us and said, hello, you know, so nice to meet you, blah, blah, blah. Bad taste. Anyway, and they carried on talking, and they said this, we're so pleased to see you together.
Because they were convinced you absolutely despise each other.
Because we thought you hated each other.
It was great. We did separate selfies, so, you know, we kept going.
Under surveillance this morning, President Joe Biden defending Israel's decision to send forces into Shifa Hospital. Biden saying Hamas's use of the facility against international norms constituted a, quote, war crime. The UN and Middle Eastern countries, including Jordan and Turkey, condemning the raid. Israel, Lisa, saying its soldiers found weapons and other military equipment, showing the hospital was used as a base by Hamas.
Okay, there's a lot here to unpack. First of all, the U.S. is backing what Israel is saying, that this is used as a military base. And there was some acknowledgement of Hamas using hospitals as military bases back in the day. There is a question and a lot of allegations of war crimes for using the hospital as a human shield and also for going into a hospital. The big takeaway for me, just sort of zooming out away from a very emotional conversation, is the pressure is building. And there is only so many more weeks that this can can go on before it becomes completely untenable to continue without some sort of resolution, which is why I am watching some of the discussions around some agreement to give back some of the hostages and some sort of resolution on that standpoint.
So what we achieved in Washington yesterday, away from all of this, we've managed to avoid a government shutdown. What that didn't include was aid for Ukraine or for Israel. So the fight that's about to take place in the new year down in Washington, Lisa, given everything that you've just said, over spending cuts after some of the warnings we've had from credit rating companies, over providing aid to Ukraine, Republicans increasingly against some of that, and providing aid to Israel, where you see, I would say, a fringe of the Democratic Party getting bigger, opposing that effort as well. This is going to be really messy in the new year.
Especially because time is running out, right? And that's sort of another question. There are some question marks about where the funding is coming from. The Pentagon has delivered a number of weapons to Israel without having some sort of increase in the funding requirements. But you're right, this is going to get increasingly messy, increasingly political, which is just, again, amps up the pressure to come to some sort of resolution, if not resolution, some better space in the next couple of weeks.
In California yesterday, it was just sunshine and rainbows, a beautiful thing. China and the United States playing happy families. President Xi Jinping speaking to some of the top US executives. BlackRock's Larry Fink, Apple's Tim Cook, Blackstone's Steven Schwarzman, Bridgewater founder Ray Dalio. Some of the names granted a place near Xi. China's leader telling the audience of business leaders in America, China does not seek sphere of influence and will not fight a Cold War, Lisa, or a hot war with anyone.
This was changing the mood music. We definitely felt that there was some kind of progress, just that they were talking. How far this goes, especially during an election year, again, remains to be seen, because there's no candidate for president. I mean, it just goes to the divide between some of the happy talk and the populace in the United States.
The pandas are coming back. The US zoos.
I'm
Speaking
excited.
Of happy talk.
I like
this.
They're so cute.
Honestly.
The pandas are coming back.
You're just rolling your
The
eyes. You brought
pandas
it
are
up.
coming back. The airlines are coming back, and all that is tangential and removed from what we're talking about. And Robert Kaplan, in my book of the year, The Loom of Time, John, it's on the greater Mediterranean. It's not on China at this time, but it's all the same. The U.S. has a human rights-led politics. Is anyone listening? Is China listening? Are our commercial titans listening to a human rights dialogue out of Washington?
So many of these meetings, Tom, are for public consumption. I was looking at the table yesterday on the US side. John Kerry was sitting there, the climate czar for this administration.
Sure.
And clearly they want to put pressure on China to do something about pollution. And this is something China, I imagine, wants to work with them on. But Lisa, ultimately, what happens? Let's be, really realistic about this. China continues to pollute and then sounds the words solar panels. That's how this plays out. I always get the feeling that if Kerry turns up, they're almost sort of laughing to themselves because they know how this works, Bramo. You get to say, this is an area we can work on. This is something we can do something about. Meanwhile, what happens? What happens domestically? We know what happens. And then what happens? They produce the solar panels and they sell them to the world. Who wins? Who wins?
It's a great question, and it's the reason why I think there's a lot of skepticism around this, the reason why the mood music's going to change a lot come next year.
There we go. Brahma wants to wrap up that convo. Let's finish on this. TK, this was just
important. Finally.
You're calling
Formula
me out.
One. I know. I could sense it in your voice. Las Vegas this weekend. Ticket prices for F1. Hotel room rates tumbling. The cheapest tickets for Thursday night selling for $119. Friday, $259. This according to reseller TickPick. Both less than half what they were a month ago. Liberty Media, the owner of F1, starting to lower profit expectations for the race. Tom, we've made a massive effort to cover Formula One this year, but we've talked repeatedly to guests that have come on this program. Is F1 chasing commercial gain at the sacrifice of the sport and sport and integrity? And I've talked about going to places like Vegas, Miami. We'll see what the track is like this weekend, Tom. I'm not a big fan of doing these things. And it looks like at the moment, I'm not going to say it's falling flat on its face, but it's certainly not turning out to be the big thing people thought it would be a few months ago.
I think we've done great coverage on this, led by John Farrow, I should point out. And John, I'm not going to talk car talk here. I can fail at that. But I'm going to equate it directly to Target's price chart, in that you've got a pandemic bulge here that was the Netflix special. Everyone has rechanged their strategic vision off of a Netflix special, and at some point that special ebbs away to where the next Formula One is. Is it 3 races in the United States in a given, 23, 24 race season? I don't see it. I just don't get it. You got Austin. Is Miami the other one? Help me.
Yeah.
I thought Miami and Austin were really boring. I thought Brazil was great because I'm an amateur. Brazil had hills. They were going up and down. They were going, no, come on. They were going up and down versus going around. What's Las Vegas going to look like? It doesn't even know. It doesn't even look safe yet. Are they going to put up all the pads and all that?
They're desperate to break America. Absolutely desperate to do it. Well, it's funny. Mike McKee sent me this article yesterday, and he said, look, no one watches Formula One. And he talked about ticket prices going down and the viewing going down. And then I went on the Bloomberg terminal last night, one of the most read stories. So it's like people like to follow the spectacle, Tom. They like to follow the spectacle, and this is still a spectacle this weekend.
Should we see if George Concalves wants to weigh in on Formula One? Let's do that. On rates, George Concalves, too quickly here, head of U.S. Macro Strategy, MUFG, this morning. What a week it's been, George. What a November already, halfway through Q4. Remodel, readjust to get to the end of the year.
And by the way, John, Tom, Lisa, I mean, for those that know me, I have a pretty decent car game as well, so if you guys want to go into cars, we can do that as well. But, you know, decent on rates as well, I think. Look, it's been you know, and we've been trying to figure out, you know, is the Fed really done? I think that the market's now drawn that conclusion post-CPI. But, you know, when you're on a hold, that's, you know, equally as challenging. I mean, typically in the past, vols come down, and we've seen rate vols come off. We've seen the market collapse in rates from the 5%, which we traded there for like 5 minutes. So like, it's really not fair to say that we really touched 5% if we only had a few transactions go through. So I think, you know, we're trying to establish a range here.
Is Walmart a good macro signal for you, George?
I think the retailers and just overall consumer spending is obviously an important macro signal. We think linear, but the world operates in nonlinear fashion, and I think we're noticing that the consumer overextended itself, went through a lot of savings, got into credit, and now they're realizing that they're going to have to pay it back.
You said that the world operates in a nonlinear fashion, which really was the reason why that one line screamed out to John and myself about the last 90 days. Walmart saw a real drop-off in consumer spending. Is that significant to you as much as it is, not just for a stock-specific type of story, but something more?
I think it's speaking to this idea that, you know, we've entered into the end of the year. It's been an intense year. A lot of spending, there's uncertainty around where the consumer really is. And now with, you know, post-student repayments, bigger debt burdens, high interest costs are finally sinking in. I think we've been impatient with the long and variable lags, but they're coming and they're here. And I think that it's all just emblematic of that.
George, model out the 10-year yield. I mean, I understand you've got a broader remit now at MUFG, but let's go back to the old George Concalves. Where's the 10-year yield in a year?
It's probably sub 4%. I mean, if we like literally 1 year from today, probably sub 4%.
Okay, I mean, sub 4%, John, to me is game-changing. I mean, that really, what does that do to the 30-year mortgage rate?
I just got a message from someone regarding our conversation about Formula One and said, could it be a leading indicator of consumers beginning to push back? We started to see that. We saw that in Burberry a little bit earlier. It's too difficult, George, to draw these conclusions. I think to Lisa's question, whether Walmart is a decent macro signal, you look at Burberry, bad numbers today, but I can give you lots of reasons as to why Burberry specifically is having problems. Formula One this weekend in Las Vegas, some pushback against high ticket prices. But again, I can say the same thing about Formula One in America, given the dominant season we've had by one team, one driver. Season's over. George, what do you look for that kind of leading indicator of a slowdown?
Look, I mean, there's a lot of these things could be idiosyncratic, and I agree we shouldn't, like, you know, over-embellish and extrapolate too much, because that's what gets us into trouble to begin with. But I do look at, you know, the second-tier data of the large components of growth, inflation, the labor market, and a lot of them have been signaling in the PMIs and all the sort of signals. You know, the sentiment signals have been suggesting that we're in some sort of slowdown, definitely manufacturing-led. But, you know, the underlying of the labor market has been getting softer. Inflation, we clearly now see is falling off pretty quickly. And that really kind of poses an issue, considering that a lot of it has been energy. Core probably will kind of bounce around a little bit until we actually get really a breakthrough and make a run towards 2%. But, you know, we're all kind of splitting hairs in many ways, because it's really the end game. If we know that we're eventually going to get closer to 2% by sometime in 2024, why would the Fed keep rates at 5.5%? I mean, they're ensuring a recession at that point.
George, got to leave it there. It's good to catch up. George Concalves there of MUFG. If you're just joining the program, equity futures down here by about 0.2%. Jobless claims coming up a little bit later. Bramo, this is the one for me. if you can make excuses for the likes of Burberry, you can make excuses for Formula One, there are tons. If claims start breaking out, you can't make excuses for that, can you? The problem with this, though, is that I've heard from a lot of economists on Wall Street regarding the labour market who think that this could be a downturn, yes, but ultimately one where people hoard labour, given the difficulty that they had hiring in the pandemic, Lisa, and coming out of the pandemic.
That's exactly what I was going to say, is that not only is this a lagging indicator, it might be a faulty indicator this time around because people are going to be very reluctant to lay people off, which raises this question, could you see the downturn without that signaling anything that leads it, but instead is a very much late to the game type of metric?
We'll talk about the retailers. We've heard from Walmart, we've heard from Macy's, we heard from Target yesterday. Coming up next, Judge Crum of Gordon Haskett on the outlook for retailers in America. From New York City this morning, good morning to you all. Equity futures just slightly negative. This is Bloomberg.
So let's go inside the boardroom. Let's suppose you win a proxy fight and/or you just get invited onto the board. You go to your first board meeting, and you're the person who's saying you can fix this company, and all of the others on the board of directors are saying, well, we're doing pretty well. How do you get received when you start saying, here's what I wanted you to do?
Well, first of all, we don't bring that to the boardroom. Our time is spent with the CEO, the chairman, the CFO, and share our plans with them outside the boardroom. We try never to solve an issue in a boardroom. Okay, it's always best done the day before, the week before, outside of that room. We wouldn't be there if they really were doing well. So it's really hard for them to straight face and tell us we're doing well. And we present them with a plan.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
You're seeing a consumer that is certainly exploring many different channels of spending, including online, and that creates a lot more opportunities for them to get products. And it also creates a lot more need for retailers to compete with these big moments in time where they offer promotions. And I think that's what's going to be indicative. So we'll learn a lot from the Black Friday period, and it's approaching very quickly.
Michelle Mather, the MasterCard Economics Institute chief economist for North America. On the consumer in America and retailers, we've got a retailer right now we need to talk about. The biggest in this country. Walmart is down 8% in the pre-market. Session lows, and it's not really about the numbers. The numbers are okay. The outlook wasn't bad. It's the commentary around the numbers that is the problem, about this sharp sell-off in the weeks of October, Lisa, and what could be in store going through the next few months into year end.
Two thoughts. They understood this, and yet they didn't decrease their full year outlook. So this raises this question of how much are people actually looking at the numbers, how much are they actually looking at the economics of it, and how much are they looking at a valuation that was at record highs and the potential growth that was implicated there, and saying actually they're probably not going to be able to achieve it. And that, I think, is a story that is much more nuanced and difficult to make it something macro to carry through.
Tom's on top of Macy's, just for you, TK. Stock is higher by more than 10%. In the pre-market. Macy's up, Tom. Leaner inventories going into the holiday season. Numbers were okay. Two very different stories right now, Tom, in early trading?
I mean, I'm looking, John, at Walmart and what's driving their sales, and part of it is, this is a little table tree, John, for the entryway. 24-inch non-lit Sutter pink spruce artificial Christmas tree by holiday time.
Who's that from, Macy?
This is from Walmart.
From Walmart.
This is
okay.
popping in. I mean, this is an attractive price at $9.96.
I was very impressed with logistics coming out of Home Depot.
And you said Gap was challenging.
Home Depot's great. Gap's very challenging.
Yeah.
If you want frictionless exchanges with a retailer, I did not get that.
Well, I like what
Gap.
McKee said. Where McKee lives, he's near some place where you can take back the Amazon, and they order tons of stuff, and he just walks over and hands it to them and
Don't they do that? Is it Lowe's as well? Don't they do that there too? Is it one of those stores?
Yeah.
Yeah.
Tied.
Like that. Haven't done it.
It's the retail experience. We talked to a lot of experts on this, and this is what you get if you get a double degree at the acclaimed Holy Cross, the College of the Holy Cross in economics, in accounting, the hyper detail mathematics ratios, the financial analysis of retail that Chuck Graham is acclaimed for. He's a Gordon Haskett. I'm not going to mince words. We protect the copyright of all of our guests. Get his brilliance from Gordon Haskett. How do you go and outperform on Walmart with a 30 PE? Explain why Walmart has a PE like a luxury goods purveyor.
I mean, Walmart's been executing flawlessly for several quarters, even maybe the past couple of years. And the business mix shift and the gross margin visibility. I mean, there's never been a time in the 20 years I've covered Walmart where I've been this bullish on the long-term outlook. Clearly today, it's interesting. It's a little bit about positioning. You guys talked in your remarks about valuation. That's a factor. If you really dig underneath the covers here, it's really less about the top line, and I think less about the back half of October commentary that the CFO recently made. I think it's more about the margin flow through. That was disappointing. The U.S. margins were disappointing. So when you have a stock at an all-time high at very rich valuations and you get a little bit of a disconnect, you get this negative reaction. I think the stock will come back throughout the day and over the next couple of weeks, but today could be difficult for the stock.
Can they compete with Amazon, or dare I've never said this before, Chuck Graham, but can they beat Amazon?
I don't know if they can beat Amazon, but they can definitely compete. And I think the physical assets of their 4,000 plus stores in the country really provide them with being really close and being able to connect with their customers. So Walmart Plus, there's a lot of opportunity there. So can they beat? Probably not, but can they compete? 100%.
Chuck, you said that margin's disappointed, and that's really interesting at a time where people are wondering when are consumers going to start pushing back on price increases. Is this an indication that Walmart is seeing that time is now, and that in order for them to compete, they've got to take a hit on the margins?
Well, I think almost uniformly, consumers are pushing back on price, and that's why prices are coming down almost across the board. And we cover Home Depot, we cover TJ, we cover Target, Macy's, Walmart. They're all talking about prices starting to flatten out and retreat. I think the U.S. margins were softer because of the GLP influence on the margins because of the drug. It's a lower margin product. It was a higher sales here in the quarter. And when you have discretionary sales be softer, those are higher margin categories for Walmart. So it's really a mixed factor. It looks like obviously the call's at 8 o'clock and the callbacks are later in the day. So we'll get more clarity later in the day. But looking at what it looks like now, I think it's more of a mixed factor.
We were talking earlier about what's good news or bad news for the broader economy when Walmart does badly or well in terms of which consumers are shopping there. Is there any read-through based on the earnings that we've gotten from retailers about whether we're seeing a division between haves and have-nots, about whether we are seeing any broader trends in terms of how the consumer is evolving, which areas are going to be bright spots and which won't?
That's a great question. I think it's really too early to tell. I mean, you look at Walmart's numbers; they're up, comp up 5. Target yesterday down 5. You look at Macy's down 6 or 7 here. It looks pretty uniform. I think there's pressures across the board. It's not really like the high end doing well. You guys talked about Burberry earlier. We'll get more color from Nordstrom next week. I think it's pretty uniform across the board. And we've been talking about our consumer surveys being weak, traffic being weak. Today's numbers and the reactions here over the past 48 hours have really nothing to do with the top line. The top line and the sales are pretty much in line with where people thought. It's positioning, and it's the margin flow throughs for certain companies.
What's the future of Nordstrom's? The family dynamic and also the attempt to be luxury. I guess what as an amateur I'd say is accessible luxury. Is Nordstrom a sleeper for 5 years out?
I think it's a great concept. I think the rack has really been their Achilles heel over the past several years. So if they could get the rack fixed, I think the fact that they don't have a huge presence of full line stores across the country is actually a tremendous asset vis-a-vis Kohl's or Macy's, which have got hundreds of stores. So I think it's a viable concept. They need to get the rack fixed, and that's what people and investors have been waiting for.
Chuck, what's the rack?
It's their off-price division.
And what do you mean by fixed? What's wrong with it?
When you look at TJ and Ross comping up, low to mid single digits, and you see the rack comping down, it's been broken. I mean, their business hasn't been good. It seems like there's been some cannibalization across the store base. We're not exactly sure. There's been some merchandise issues. They've tried to price up when the consumer wanted to be priced down. But yeah, the Nordstrom's viable for sure. But the rack division, their off-price division, I'm sorry for not clarifying earlier, is really the...
No, it's okay. No, I know. I'm just for people who are trying to follow. Have you noticed, Chuck, that the off-rack, the rack, is actually close to the Nordstrom stores? Have you noticed that? Which is kind of odd.
Yeah, I mean, I could tell you my wife will tend to go to the rack now a lot more than a full line. So that's what I'm talking about. The cannibalization factor of that is probably maybe the issue here. And maybe they need to close more rack stores. But, ironically, they're trying to grow more right now. So we're hold rated. We're kind of perplexed on some of the strategies there for the time being.
It's trying to be TJX and Nordstrom at the same time, which with the same branding is hard to do. Chuck, thank you. Chuck Grom of Gordon Haskett. Thank you, mate. The stock is down by about 7%. I was thinking of Kohl's, wasn't I?
Yes.
That's where you take your Amazon stuff back.
Yeah. I don't think it's... But then, there was a question of whether that actually was bringing any traffic. With Whole Foods, they actually are connected to,
Same company.
Thing.
Yeah, same
so
thing.
It's actually, just more.
To Chuck's point on Nordstrom Rack, it doesn't really make sense. I mean, I drive past one every morning. It's kind of odd.
If you want to have the same branding as Nordstrom and you want to shop at Nordstrom, why not go to the rack and get lower prices?
Saks do the same thing,
Saks off Fifth?
Yeah, Saks off Fifth. It's like, and it's just around the corner from Fifth.
Right.
It's
like,
I'm looking at a rack here. John, this is something you'd wear cash on the weekends. A Brooks Brothers Sport Fit corduroy shirt jacket. Sort of an off-white kind of thing.
Can I just say, this is the way the show's been going this morning. We mentioned a retailer. Tom goes to the website, picks out a product for either him or one of us.
Honest to God, I've never been in a Nordstrom rack or a Nordstrom.
I've never been in a Nordstrom,
no,
okay.
$148, John. It's selling at $27.97. How do you do that and build a brand?
I've never been in a Brooks Brothers.
It's 81% off.
A Brooks Brothers, those suits that are like really broad.
Long Island made. I wore their tie last night.
Are they those suits? Those like boxy jackets that are like...
They're like Franco-British.
They're 2 inches past the shoulder on either side.
This suit...
It says it's a 48, but it's like a 52.
Well, that's all,
John, this suit is based on a 1950s Brooks Brothers box suit.
Pinstripes.
Don't even listen to me,
Like that. Like that.
Yeah.
Is that what they are?
No, I mean, they had different sizes and shapes. I love that you're coming to me for suit guidance, which I actually know more about because I have been to a Brooks Brothers than other people.
Okay. Do they do tailoring there?
They do.
Okay. So like the suits fit?
Yeah, but I think that they went bankrupt.
Do you shop at Brooks Brothers?
Used to for years. Moves the buttons. That's what the tailor said when I was 8 years old.
What they say?
Moves the buttons.
I don't know what that means.
They'd yell out, moves the buttons.
Why?
I'll tell you about this suit. This is based off a 1950s Brooks Brothers suit.
Yeah, no, I can tell. Let's talk about it next.
We have been so used to the fact that every time there's a problem, central banks come and ease. This has been the kind of playbook, throughout my career, before that, after I left. Now we're in a very different environment. Central banks actually have to create a recession, in essence, to get back to price stability. So it's a complete reversal of the modus operandi, in a sense, of central banks as they've known it for the last several decades. So that's why it's not so much that they're getting something wrong. They've now acknowledged that there is this trade-off, these costs to pay, but it's a completely different way of thinking about central banks, and it's a different role. Another way to put it is they have to be unpopular now in order to get inflation back down, where it used to be you could count on them each time to rescue you, to stabilize the system, to bring support. And that has shifted. And I think many people, even in the markets, have not quite understood in my mind how much we are now in a different regime compared to the last 4 decades, effectively.
So it's what, almost an easing bias in the markets? How would you describe it?
In the U.S., yes. And I think it's this idea, this almost pre-programmed idea, when there is a problem, i.e. potential recession, central banks will come and ease.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Today, I would say perhaps only second to AI right now, which is AI has got so much going on and folks are so excited about it. Climate tech is the hottest area to be in.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
Right.
so it's ready right when you pull up your car.
How do you manage these kind of 2 different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
How quickly does the Fed cut, or do they cut? If they cut, then I think we're off to the races.
I think the Fed is going to be patient here, but I don't think this is a victory.
The Fed definitely wants to continue QT for as long as they possibly can.
The high level of interest rates goes back to how the Fed is trying to calibrate this economy.
The worry is that the Fed will not be cutting rates by May of next year, but rather probably by the third quarter or maybe even later.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrell, Lisa Abramowitz, and Tom Keene on radio, on television. Thursday claims in this hour. Haven't even mentioned it today. In 29 minutes, we did. Jobless claims. I didn't hear it. Jobless claims. And I mean, I'm sorry. We're going to see this. Is this like a big? Is this like a big number today?
Sometimes I feel like you don't listen to me.
I don't listen to
And
you.
then later in the show, you confirm it.
But weekly data, seriously, weekly data, retail sales, CPI, and everybody's going, okay, what's the now what? I would center on NVIDIA earnings next week. But I'm sorry, Walmart today and claims this makes it a valuable Thursday.
There are things that matter to the market, and there are things that matter to this economy. NVIDIA earnings, given their outperformance this year, given the market cap, massive for the market when we get those earnings, Tom.
Apple-like.
The retailers, small and large, may be more important for the broader economy and the US consumer. So let's pick a name. Walmart in the pre-market, down by something like 6% at the moment, just off session lows, coming out with numbers a little bit earlier. But ultimately, Tom, just a guide from them, not the numbers, the commentary on what's happening with the US consumer. That's going to get the conversation going into the opening bout. Bit of weakness out there for Walmart.
Chuck Graham, optimistic there at Gordon Haskett on Walmart. And again, he says they're dominant. And I wonder if that's the theme. I'm not there yet, but the theme yet for 2024 is the dominance of select ginormous companies.
And we've been seeing that, and that's the reason why some of these dominant companies are perhaps better reads on the real-time consumer appetite than even some of the lagging macro data. Just to build on John's point, this idea that consumers are pushing back on price, we heard that from Chuck Graham. We saw that with margin compression in the United States at Walmart. And then the larger read-through of, okay, yes, they might have a really good view in terms of consolidating business. They're seeing a more rapid drop-off in consumer appetite. That, I think, will get people's notice.
Can we fold that, guys, into a real GDP guess for next year? I'm hesitant to do that.
That's tough, Tom.
Because I just don't have the set of data-dependent now or forward so I can go, in 6 months, GDP will be 2.3%. I've got no basis.
Tom, it's both the best and the worst thing about earnings season, that you can cherry pick some companies and tell whatever story you like.
Yeah.
You can do that this morning. Across income groups, you can pick Walmart, and then you can pick out Burberry out of London and talk about even the high-end income story really starting to fade, Tom. The post-pandemic luxury boom is over, looking at Burberry. You can make all of these different examples, Tom, but ultimately, that's why we're looking at claims this morning. That's why I'm going to claims to see if there's really that kind of weakness coming through this labour market, and claims are starting to break out a little bit more.
In the parsing of earlier this week of Morgan Stanley and Goldman Sachs, I think we all agree it's an unemployment call, a labor call, that gets them to what the Fed will do, and part of that is the dynamic of claims, the 4-week moving average, and continuing claims as well.
Goldman think we can continue this expansion, that we can get inflation back towards target without unemployment surging. Ultimately, if there's consensus on Wall Street, and Lisa and I mentioned this a little bit earlier, and I think it's important, there is this belief still that, Lisa, even if there is an economic downturn, people are going to hoard labour, given their experience to hire people over the last few years.
And that could cushion any kind of downturn, because if people are employed, they're not going to feel that pessimistic, and they will keep spending. What I'm trying to wrap my head around right now, and forgive me, I'm thinking aloud, as I often do on this program.
That's the show, Lisa. Go for it.
But I'm I'm thinking to myself, okay, if you see nonlinear changes in consumer appetite, and Walmart signaled that they are seeing a non-linear change in the past 90 days. Is that coherent with the soft landing that people are talking about? I don't know the answer to this, but this is what is sort of keeping people up at night, right? Are we looking at a change with the long and variable lags as we parse hairs, as George Concalves said, that start to take effect in that non-linear fashion?
To go to the wild side, if you get Ed Yardeni to SPX 5400 the end of next year, does that pop a 32 or 33 multiple on Walmart? Did you get a 10% multiple expansion on Walmart from 30 out to 33? Chuck Graham, he's in that camp, frankly.
I love some of the calls on Wall Street. Goldman Sachs, 4,700. Not this year. Next year, we're at like 4,500 right now, Tom. Futures at the moment, negative 0.1% on the S&P, pulling back just a touch. I've mentioned Walmart a few times. That name is down about 6% in the pre-market. Yields coming in about 5 basis points. This bond market's still all over the place, to be honest with you. The 10-year at the moment, 448.43. The 10-year right now is exactly where it opened last Thursday,
that was great
a week ago. I think you've got to keep coming back to that. All the volatility in between. The narrative switching from one side of things to the other. This 10-year, Tom, is back to where it opened a week ago Thursday.
Well, a week ago Thursday, I'm going to do a 10-day chart on what I'm looking at, and people are ignoring this in the West, the Western world, the far side of the world. Lisa, euro yen, a 164. It's up 4 big figures over a cup of coffee or lovely tea. And the answer is the high at 3 a.m. this morning, 164.30. I call that untenable.
Well, there's this question of what point the Bank of Japan quagmire breaks, and what that does to some of the volatility that we've been seeing, certainly even in U.S. yields.
Maybe it's off the chart, but that's what I'm watching. Euro yen right now, and equities, bonds, currencies, commodities. Distilling this in a really wonderful voice of just how to frame out the 14 narratives we've been talking about is Michael O'Rourke. Decades of work with chief market strategist at Jones Trading. Michael, I've never seen it as crazy. I could not write an outlook now with great respect. How do you get out 6 weeks? But far more importantly, how do you frame an outlook out 6 months?
I think that's the key point here. We're at this inflection point that people are unsure. Are we going for the soft landing, or is the slowdown in inflation, the slowdown in economic data, is it going to lead to something larger? I start with what I know and what I believe we can count on. I believe the Fed's done raising rates. I believe that part of the process is complete. So I'd be looking for names that are, investments that benefit from that. That's why I think the banks and interest rate sensitive names like REITs, utilities are probably safer bets. The problem is when we get a weak CPI, not even a weak, that we still have 4% core CPI. We still have an inflationary environment, but slightly better than expected number. The market automatically translates no more rate hikes to, okay, we're going to cut 100 basis points next year. Yep. And I think that's the issue. It's just, it's a manic reaction that people just have to, take a step back and look at the data they feel confident about. If the Fed cuts 100 basis points next year, that means we probably have a really significant economic slowdown emerging that you would not want to be aggressively buying stocks in. So I think you have to just go with what you're sure about and then let the noise just play out.
Michael, it's difficult to do this on TV because the following question deserves a lot of thought, but I'm going to throw it out there anyway. If higher interest rates didn't slow this economy down, do easing financial conditions speed it up?
They probably do. They probably do. But here's the question. Like, everyone, has gotten excited about the Treasury rally, right? We're sitting here with a 4.5% 10-year yield. This is where we were back in September when we first hit this. It was the first time we hit 16-year highs a couple of months ago. We're still at very, I don't want to say high yields, but high relative to where we've been for the past 15 years. So while financial conditions have eased somewhat, a lot of that's the stock market rally. And I think, like I said, I think a lot of that's the noise. We're still at what I would say is an attractive bond market environment where if you could buy the 10-year at 4.5%, that's attractive. And we know we still have a significant Treasury issuance coming. It's not like the rally in the bond market means Treasury, the profligate spending in Washington has ended and that issuance isn't going to materialize. So like I said, I think people have to kind of step back from the noise and you have to realize, a lot of the things we're looking at are still the same. They didn't change in 2 weeks.
Well, you said to look through the noise and go with what you know. What do you have conviction around in an environment where, as Wei Li said, you blink and there's a new narrative?
Well, I have conviction that the Fed is probably done and that their interest rate hikes are done. What I would not have conviction about is the fact that the market believes they're going to start cutting immediately just because they're done hiking. And I think that's the issue here. If you look at the trends of where the 1 month, 3 month, 6 month core CPI annualized rates are, we're still trending above 3%. And the Fed does have to get inflation back to 2%. That they say is their job number one. I think Chairman Powell did himself a disservice by dismissing the set projections from the September FOMC meeting because that got the market excited that the Fed's going to cut rates earlier. But we need to get that inflation down, and we also need to do it without creating a significant downturn in the economy. And when we talk about the slowing data, whether it's the earnings, whether it's the economic data, like we have, that's a risk. I think Powell has been on point that households and businesses borrowed at low rates, so they're well funded for the time being, and that's kept the economy expanding. But that is likely to run out of room next year because rates are higher. And to your point about jobless claims, I think they're really important. You guys are talking about, like, if we see initial jobless claims tick above 250,000, you start getting concerned there, and then when they move above 300,000, you get worried. So I think those are things you want to keep an eye on.
To that point, John and I were talking earlier about this sort of labor hoarding dynamic of this recovery. Can we get a clean read from these jobless claims?
Well, I think you're right that jobless claims are going to continue. They are strong. They have been strong, and they're going to continue to be strong for a little bit. But that's my signal that real weakness will have emerged. And we just don't, again, we're at this inflection point where we still don't know if it's a soft landing or a graded downturn. All we know is the data is cooling, the economy's decelerating. How quickly, it just remains a concern. But I'll also sit there and say, we have the highest interest rates we've had in 16 years. The longer this environment persists, the more likely it is the slowdown becomes, and the more severe it can become. that is one of the problems of having this easy policy for so long,
yeah,
and allowing people to build those reserves up with low borrowing.
And looking ahead to claims in about 20 minutes,
Yeah.
we'll be focused on that. Michael, we've got to leave it there. Michael O'Rourke of Jones Trading. Thank you, sir. Appreciate your time. If you're just joining us, futures right now, negative 0.1% on the S&P. Lisa, that question I asked, if higher rates didn't slow the economy down, will easing financial conditions speed it up? Mark Dow out on Twitter, inspiring that one. I think that's a really interesting question. How asymmetric is that?
It's a great question. I don't really know, right? We don't really understand the vectors of monetary policy and the implication. There's also a question of what do we mean by monetary easing? Do we mean the stock market going up? And basically, what I've heard from a lot of people, what I've heard from a lot of people is stocks will keep going up unless there's a recession, because ultimately people are still buying the American dream of stocks.
I think the arch theory would be this titanic 4-decade fear of becoming unanchored. Are we unanchored? And that gets back to, is it 2.0, 2.5, 2.x, dare I say 3.1% is the new, that's the raging fear.
This is when you expect to see a divergence cross-asset, where bonds start to rally on some bad news and equities sell off.
Yeah.
I don't think we're there yet, Lisa, but it's one to watch in the coming months, if indeed you do get some weaker economic numbers.
Does it come from some fundamental concern about a slowdown? And if it does, then it's not necessarily going to lead to true expansionary types of read-throughs in the economy.
What are you looking at?
I'm looking at all sorts of stuff out there. I'm looking, this was beneath the radar in cocktails last night after the champagne broke out. And, you know, they took a phrase from Bramo. You and I know Bramo is an envoy of friendship.
Oh, without a doubt,
She's an envoy of friendship. And there's the leader of China.
I'm a
the
panda?
pandas will return.
You're saying I'm a panda?
The pandas will be envoys of friendship.
You're the panda of Bloomberg surveillance. You make everything likable.
You are an envoy of friendship.
Roll around on the ground and sort of fall clumsily.
Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays. Our studios in New York and San Francisco. Our expert hosts of the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority.
From New York City,
from London, in Sydney,
from Washington,
in Tokyo,
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening. Here's what I'm watching. You do not want to miss this story.
Is there the kind of upside?
I believe these are some of the most constructive and productive discussions we've had. I've been meeting with President Xi since both of us were vice president over 10 years ago. We've made some important progress, I believe.
And Mr. President, after today, would you still report to President Xi as a dictator? This is a term that you used earlier this year.
Well, look, he is. I mean, he's a dictator in the sense that he is the guy who runs a country that is a communist country that's based on a form of government totally different than ours.
The President of the United States speaking to the press after meeting with China's President Xi Jinping, calling him, confirming that he thinks he is a dictator. TK, could have been so much worse He could have started that story about being in the foothills of the Himalayas. You know that one? His favorite story? Isn't that Biden's favorite story?
I don't know.
And he asked me, what's America? And I summed it up in one word. What did he say? Possibility. Something like that. It's his favorite story.
All right. The best part of the whole thing is looking at Tony Blinken's reaction.
I know.
When
I've
he
seen the
said that.
pictures.
It's
Front
fantastic.
row. Front
Absolutely.
row.
Well, we're going to go to the AMA
It's like
show.
something out of Veep. He's like, oh, no.
I got a couple questions for the qualified one, but to your point, John, what if he'd said that early in the meetings?
True.
At least it was at the end.
That's why you sort of do those press conferences at the end, right? Yeah, I know. I want to talk about Walmart just briefly. The stock is down 5.5%. Lisa picked up on this one, dropping across the Bloomberg. This quote right here that's coming from leadership out of Walmart. In the United States, we may be managing through a period of deflation in the months to come. And while that would put more unit pressure on us, we welcome it because it's better for our customers. Talk about the end of the post-pandemic pressures out there. Lisa, we heard it from Burberry this morning, who have basically said it's the end of the post-pandemic luxury boom. It's a big signal coming out of Walmart this morning.
Margin compression and then potential outright deflation in the United States. Two questions. One, at what point are each of these retail stories idiosyncratic? And at what point is this sending a pretty strong message that, yes, the Fed may be done raising rates, but that what we experience might not be clean or potentially the strength that a lot of people were looking for in the bottom line of companies that have gotten bolstered, and Tom's been good about this, that have been bolstered by inflation and just the fact that revenues have been going up.
I'm just shocked you're complimenting each other. That's wonderful. Futures on the S&P, Tom. Negative 0.2% on the S&P 500. Pulling back just a touch. Yields look like this on a 10-year, down 4 or 5 basis points. TK, 448.63.
You know, McMillan's a self-made guy with a huge respect for his success in Bentonville. The board you just put up on radio, they put up the text, folks, of this deflation comment by the leader of Walmart. I can state this with certitude. There's not one single economist breathing that will tell you outright deflation is good for an economic system. They don't exist. It's in the textbooks. There's a fear. Gary Schilling codified this at Merrill Lynch. There is a fear of aggregate sum deflation, which leads to what, John, your grandparents lived in England, which is outright wage decline.
That's the consumer pushback, maybe, Tom, that we're starting to see. Maybe. I mean, it's really early days. Really early days. I wouldn't draw too many conclusions from this, but certainly we're getting some questions out of Walmart, Tom, going in the other
Absolutely.
direction.
That was a huge statement, and, you know, we'll have much more on that. Look for that across to the close this afternoon here on Bloomberg Television and Radio. Joining us now after a long night, Anne-Marie Horton, Bloomberg Washington correspondent. This from the APEC Summit in San Francisco. I guess, Anne-Marie, what everybody's going to pounce on here is, does the apparatus of the White House walk back the president's statement? Will they or did they?
Not really. What the White House is focused on is the fact that they view this as a success. What we saw out of this meeting is very much small wins only. You have to remember, when you have a big summit like this, all these tiny deliverables, they're done and set. The final win is the two-men meeting. And the point of this was that President Biden and Xi Jinping, after a year of not seeing each other, sat down. And, you know, one foreign diplomat that used to work in Asia said, this isn't about meaningful wins, it's about managing the relationship from getting worse. Biden has called Xi Jinping a dictator before. He said, well, he is, and then he explained why. He said, that is a different form of government than a democracy we have here in the United States.
What will our commercial titans say to the president's comment as they dined with the leader of China last night?
Well, Xi Jinping had a lot of dovish comments really yesterday, and I think we can interpret that as he really wants to assuage investors' concern, the business community's concern about how Gina Raimondo earlier this summer said that China is, quote, uninvestable. He wants to make sure that he puts a lid on that. He said he does not want to unseat the United States. He doesn't want a hot war or cold war with anyone. So he's trying to set the temperature at a lower level for the business community. And I think for the most part, they're going to shrug off what President Biden said as he walked out of that press conference yesterday.
Anne-Marie, do we have any intel from those business leaders when they met with Xi Jinping about how comforted they were that there was a changing tone toward international businesses doing business in China?
Not yet, but I think really it doesn't really matter what they say. It's going to be really in the actions. Are we going to see foreign direct investment pick up? Are we going to see more business leaders, more executives want to go to China and do business and set up more infrastructure and work in China? So I think really the next year or so, we need to see the actions of whether or not Xi Jinping was able to placate some of those concerns. But at the moment, this really just felt like Xi Jinping's moment to address the business community, and because he was so dovish in these comments, it really felt like he was trying to forge a path forward with the business community. But remember, we've talked about this time and time again, he is dealing with a lot of economic issues and a fragile economic recovery from the pandemic at home.
Michael Herson was on earlier, a China analyst, and he was talking about how this is sort of the grace period before the rhetoric starts hardening significantly next year ahead of the election. What are we expecting? Where are the pressures right now, both within the Democratic Party, but just more generally within the populace about hardening the line with China?
Well, it's a great point. I think it's part of the reason why Biden didn't shy away from calling Xi Jinping a dictator as his final comment when he left that press conference. He has been under the gun by Republicans, and he's going to an election year, that he's not tough enough when it comes to China. The fact of the matter is, this administration, yes, they're engaging with China. Biden has said he wants to make sure he's managing this relationship so it doesn't veer into conflict. But at the same time, they kept the tariffs in place, and they've added more penalties when you look at some of these export controls. But still, they will be pressured that they're not tough on China. I think it's one of the reasons why Biden wasn't shy from saying Xi Jinping is a dictator yesterday. But the rhetoric is certainly going to heat up the closer we get to November. I mean, you look at Congressman Mike Gallagher from Wisconsin, who leads the China Select Committee. He was running he was part of a protest over the weekend against Xi Jinping coming here. And then he also wrote a letter and was kind of mocking all these CEOs who he says paid $40,000 a ticket to sit at that dinner last night.
Is that true, Anne-Marie? I didn't know that.
I didn't either.
They actually had to pay to sit around that table?
Well, this is according to Mike Gallagher, and he wrote a letter to organizers about why are we selling these tickets. I will come back to you with actual prices and what was potentially what potentially this cost. But according to Mike Gallagher, who wrote this letter, this was a $40,000 ticket, and as we've written, this was the hottest ticket in town. People wanted to be able to have FaceTime with Xi Jinping.
Thank you, Anne-Marie, on the ground over in San Francisco, California. I think we'd love some clarity on that particular issue. Pushing ahead from here, jobless claims in about 5-6 minutes' time. The estimate for claims is about 220. The previous week was 217. We're going to look to see if that pushes higher. I want to go back to Walmart, which is down about 6% in early trading. I think the quote you're going to hear a lot this morning is this one right here. We may be managing through a period of deflation in the months to come. They've talked about a sharper slowdown in some consumer activity in some of the weeks in October, and maybe sort of raising a question what this is going to bring us into year end. I'm going to ask this question to Mike Kontopoulos of Richard Bernstein. We'll catch up with him at the Open in about an hour from now. Tony Rodriguez of Nuveen, Amanda Lynham of BlackRock. These are questions, Tom, that I think a lot of people want answers to going into year end.
Amanda's absolutely perfect to address that. My basic idea, and I'm speaking quickly here ad hoc, is a 3-month annualized moving average of negative price change on CPI or core CPI would be just it'd be thunder across the American landscape. It's frankly unthinkable. You know, we've seen it in other nations, particularly during conflict, but in coming out of war, supply side shocks, World War II, and that. But it would be stunning.
How much would you pay for a ticket?
I'm sort of shocked by this. I think Lisa's up to speed on it. New York Post writes it up. Bloomberg has it, as Anne-Marie said.
Who gets the money? Who are they paying?
That's the question. Who are they paying? Well,
the conference organizer.
It's a hell of an horse divorce.
Amazing.
The EU is one of the largest and wealthiest consumer markets in the world, and there are very few global companies that can afford not to trade in the EU. So as the price for accessing the European market, these companies need to obey European regulations. That's not surprising. But often these companies choose that they will extend the European standards across their global conduct and their global production because they want to avoid the cost of complying with multiple different regulatory regimes. So there are benefits to standardization, benefits to uniform production. So all the EU needs to do is to regulate the single market. And it's then the market forces and the business incentives of global companies that transform that EU rule.
Lots happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions. That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
Non-news day, no it's not. There's actually a Seattle slew of economic data today, all through the morning, and Michael McKee will provide leadership on that. Lisa, it's claims, it's weekly. Guess what? It's important.
Especially given the fact that we're seeing some of the commentary out of retailers about softness. If there is some confirmation from jobless claims, do we see another disproportionate reaction in markets? And
John Riding of Breenex Bear Stearns would say, and import prices are important. The data falls, claims wander out. Ooh, in an elevated direction. We migrate to Michael McKee.
Yeah, 231,000 initial jobless claims filed last week. That is up from the initially reported 217. We'll get the revision in just a moment to last week's numbers, but 218. So not much change. So it is a significant increase of about 13,000 or so. The continuing claims number is 1,865,000, up from 1,833. I thought maybe we would see some of the continuing claims go down as the auto workers went back to their plants, but that doesn't seem to be the case. So if you are looking for a story about the economy and the labor market getting a little softer, you might find it in this week's jobless claims numbers. The import price index comes in higher, much higher than anticipated, up 0.6%. Ex-petroleum, though, down 0.2. So it's kind of hard to separate that out because what we've seen is gas prices coming down, oil prices coming down. So we'll have to look further into that. On a year-over-year basis, import prices are down 2%, which is more than had been anticipated and more than the 1.7% last week. And then we've got the Philadelphia Fed comes in. The Philadelphia Fed headline number is negative 5.9. That is up a little bit from negative 9, and prices paid comes in at 14.8 after 23.1. So a big drop in prices paid for the Philadelphia area.
Review that further, Michael, and there's a ton of data coming out this morning. Ellen Zentner to be with us momentarily. Lisa, I go right to the 10-year real yield, which is now testing the low inflation-adjusted yields of 2 days ago, the shock of 2.15%. We're not quite there yet, but the bond market readjusts immediately off this data.
Yeah, I'm just looking at nominal yields and just going much lower on the heels of some of this across the curve, not only a 10-year, but also 2-year, sort of edifying this idea the Fed is done. Taking a look at the labor market starting to give way on the margins, Tom, I do wonder, especially now with a 2-year yield at 4.84%, fluctuating around, are we looking at cuts? Are we looking at a real slowdown, or are we looking at a normalization? And especially with all of the retail sales, that's going to be the key question this morning.
I didn't realize the 2-year yield really testing those lows we saw 2 days ago. I've got a low to 4 digits here of 4.8065, rounded to 4.81, and Lisa, we're 3 basis points away from that moment that was so shocking 2 days ago.
So, Mike, just to give us a little bit more color, do we have a sense of how broad-based some of these claims are, about how funky they are, or if this really is highlighting the weakness that seems to be implied in markets, albeit on the margins, not cratering, but just maybe normalizing.
It may be normalizing. Yeah, we don't have any idea that there is anything wrong with these numbers, so it does look like at this point that we're basically just seeing a few more people who are not getting jobs, and those who are not getting jobs are taking longer to find new ones. It's not a huge sign of an apocalypse in the labor market, but it does suggest that maybe the normalization process continues, which is what the Fed wants to see.
10 seconds, another wall of data today. What matters next across November 16th data?
Well, we've still got industrial production coming out. The problem with that is it's expected to decline because of the UAW strike. So you got to throw that out, unfortunately. A lot of Fed speak today, but really not on monetary policy. So I wouldn't expect much to change the market outlook based on what I do.
Well, we'll see. Michael McKee with us, and we'll continue through the morning on radio and television with him. Joining us now, we're thrilled to have her, usually for big events. Well, today's a big event. It's always a big event when Ellen Zentner joins us, Chief U.S. Economist at Morgan Stanley. Ellen, on claims, I go to the 4-week moving average. How do you interpret claims with this 231,000 statistic? And can you say there's finally a vector in place of higher claims, more pain?
So I hope that there's a higher vector in place. I disagree that higher claims would mean more pain. We're coming off of extraordinarily low levels. As you said, we look at the 4-week moving average to smooth through volatility, and it has been lifting, but it is still very low. And so what does that tell me? Something that Mike and Lisa alluded to as well, normalization, slowing and normalization. Good God, man, that's what we've been needing. And I don't see this accelerating at an extreme pace. I've been on the road the last few days in several states meeting with corporate clients. They are finally seeing some relief in terms of how tight the labor market has been in terms of the availability of the kinds of employees that they need. We're seeing not just claims rising a bit here, but I focus on continuing claims. People that have been losing their jobs are staying unemployed for a bit longer, and that's been rising since October. So it's getting more difficult to just get reemployed right away. This is the kind of softness in the labor market that we have needed. And of course, it takes pressure off the Fed to raise rates again, right? Going on extended hold.
What is the distance between normalization and an outright downturn?
So, well, the difference is jobs stay positive. So normalization is you've got more supply coming back into the labor market. So you see participation rates rising, which we have. That is what puts upward pressure on the unemployment rate. And we've been seeing that. And if people are taking longer to be able to get reemployed, then that should produce further upward pressure on the unemployment rate. But that just takes pressure off the labor market, pressure off of businesses, off of margins. You see wages grow more slowly, and you'll see confidence build among Fed policymakers that they have done enough here. I don't think we're anywhere near getting to negative job gains. I think negative jobs would mean that companies have stopped hiring. What I hear is that they're doing selective hiring, that they stop hiring and that they start firing. And I mean firing broadly, and that's just not what we're seeing. But I'm ever watchful, especially reading earnings transcripts, to see if that's something that's around the corner.
I'm glad you mentioned earnings, because we were talking about Walmart, and I understand there are idiosyncrasies here, but they talked about potentially seeing outright deflation over the next year, with consumers clearly pushing back. You do see margin pressure. You do see a market deterioration in consumer appetite over the past 90 days. How concerning is that to you about the nonlinearity of where things could be?
So, Lisa, we put out a consumer survey that goes out into the field every 2 weeks. And one of the biggest areas of trade down that households have been doing is within stores themselves, say going from a high price branded good to the generic good within the store. And that means that those retailers are going to see some deflation. And we've been hearing from businesses that input costs are falling, but prices that they're charging are falling faster. And that's important because we all started to think, we, the economics community at large, not myself, though, an exception, started to think that households just have unlimited price tolerance. And that is not the case. Finances start to slow. We run through that excess savings, and you will start to trade down. The lower income groups that Walmart serves are the groups that have been standing the greatest pressure. Look at delinquency rates for the lowest income groups on credit cards, on auto loans. That points to stress.
Ellen, Molly Smith and Alice Atkins for Bloomberg made a big splash the other day using your research, the Morgan Stanley View. And the key distinction is a 4.3% unemployment rate. I hereby dub it the Zentner 4.3% statistic. How do we get to a 4.3% unemployment rate that radically shifts Fed policy?
Well, so I'm not expecting radicalism from the Fed. The unemployment rate of 4.3%, we think, is a soft landing unemployment rate in that it is driven by slower job gains and higher labor force participation. Now, I understand that is a beautiful scenario for the Fed, and we have them cutting next year by 100 basis points because of normalization. That's very different than cutting because the Fed thinks there's a recession. If the Fed thinks that there's a recession, they're starting big and they're doing a lot. That's very different than the normalization scenario.
And then overlay with that, what we're hearing, Julia Coronado leading the way on this. Dr. Coronado suggesting productivity is underestimated. Do you believe that we have an underestimation of the efficiency of the American economy, and that gets you to a benevolent 4.3% unemployment rate?
Yeah, so I do think that productivity is being underestimated. I would add, though, that productivity has not been well estimated ever. And so you'd have to say, well, it's being estimated, worse than before. And I'm not sure we can say that. But I think there are a lot of new ways that productivity exhibits itself in the economy that we're just not able to capture. Government data is not able to capture. But absolutely, if productivity is higher, then you can withstand higher wage growth without it being inflationary. It gives the Fed more runway because it keeps a lid on inflation. And so it's really, it lifts all boats. It's productivity and infrastructure, what economists go to sleep at night dreaming about, Tom.
Which is the reason why I think people are sort of hopeful that we're going to get that and we're going to create this soft landing and avoid something more challenging. I guess to wrap it all up, we've been talking all morning about the potential for deflation. Tom was talking about how difficult that is for any economy to handle. This was the word that Walmart used, but you're talking about normalization. How concerned would you be to see some sort of material deflation, not disinflation, deflation in certain goods sectors that we have been seeing on the margins over the past couple of months?
Yeah, so Lisa, goods sectors I'm not worried about at all. Goods prices in the U.S. have been in deflation for a decade leading up to COVID. That's normal, right? We were importing a lot of deflation, but that's externally determined. I would be very, very concerned about a deflation scenario in the U.S. for services, for domestically determined prices. For us to get to that broadly, you're talking about an extraordinary downturn on the magnitude of the financial crisis in 2008 that would get that kind of price declines in the level of prices. Instead, I think deceleration is in train. I think it's going to be faster than the Fed is expecting. And I think I've been really pleased, and I think they should be pleased too with the progress that we've seen.
The Newtonian mechanics of Ellen Zentner of Morgan Stanley there and the dynamics of price change. Ellen, thank you so much for the brief this morning. Lisa, I thought you did that really, really, really well. We're going to talk about this, pick this up here in a moment. Just a quick data check here with what we're doing better. Standard & Poor's 500 on a percentage basis, S&P flat. Lisa Bramlett and Tom Keene here this morning as we talk about any number of narratives. And on the deflation, I thought Ellen Zentner really nailed the mass of change you'd have to see to get true price decline in America with our resiliency, with what the laureate Ned Phelps of Columbia would call our dynamism. We've avoided this, but it's seared into the memory of Europe.
The distinction between the goods and the services sector just keeps widening and widening, and she really made that distinction well. The idea of goods deflation, which
service sector deflation,
but service sector deflation would be much harder to see, especially because the costs have gone up so much to pay for employees, to pay for all of these base goods. You're not going to see it so quickly passing along. I mean, have you eaten out recently?
Yeah, it's ridiculous. It's like literally eating out of New York City has become no fun. I mean, that's the simple way to put it, what I find fascinating is the idea of the dynamic nature of the American economy and what those cautious would say, fueled by debt, fueled by stimulus. And so that fiscal oomph that keeps us going is that a money illusion of disinflation, inflation, or would we be in Japanese like deflation if we didn't have all that fiscal response hitting us?
This will certainly be part of the conversation next year with the political outlook. I also think it's important to see, is what's good for the economy good for stock markets on the other side? Or is it kind of baked in?
I don't know. I don't have a theme for next year yet. Send me an email me, message me by semaphore. Send a carrier pigeon. What's my theme for next year? This late in the year, I usually have like 3 themes. I got 0.
They'll change next week.
Futures that improve. Futures at -3. Bloomberg's surveillance.
Sports and money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona,
to the kabaddi tournaments in India,
to the cornhole boards at your local tailgate. This is what's next in sports.
From the world of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
On the David Rubenstein Show, Peer-to-Peer Conversations, I uncover the untold stories of the world's most successful leaders.
Watch Wednesdays on Bloomberg Television.
Numbers, they're up, comp up 5, Target yesterday down 5, you look at Macy's down 6 or 7 here. It looks pretty uniform. I think there's pressures across the board. It's not really like the high end doing well. You guys talked about Burberry earlier. We'll get more color from Nordstrom next week. I think it's pretty uniform across the board.
So is it a slowdown or is it simply normalization? Chuck Grom there, a senior retail analyst at Gordon Haskett, weighing in, talking about the potential for a normalization. We were just speaking with Ellen Zentner of Morgan Stanley, saying that what we saw, the uptick beyond expectations baked into the market with jobless claims, also a normalization. What you see in markets is no drama, especially after a drama-fueled week. We could see basically flat on S&P futures, bouncing around, fluctuating between gains and losses. Euro gaining once again 108.79. 10-year yields, look at that, Tom, an 8 basis point drop as people consider jobless claims. Yeah. It really has been this ongoing ping pong act. 4.4472.
Lots to talk about here, but Lisa, you're dead on about the yield. Like, people want give me some more equity. I'm addicted to up 1%. if the Russell 2000 doesn't go up 3% today, it's a failure. Forget about all that hype. In the bond market, there's a subtlety here, and I'm literally, if I was writing a banner at 6 a.m., I'd say it's retest Thursday. Are we going to test new low in 2-year, new low in 10-year? Dare I say new low 2.17% in the 10-year real yield. That's more important than the damn stock market this morning.
And it's because of jobless claims, and it's also because of some names within the stock market. I want to just go back to Walmart. We've been talking about it all morning. It came out with better than expected earnings, better than expected forecasts, albeit marginally so, but then comments around a rapid deceleration in consumer spending over the past 90 days. And also this line, in the U.S., we may be managing through a period of deflation in the months to come. Those shares down about 6%, Target shares down in sympathy about 3%. And this has been a concern, even as Macy's outperformed from a very low bar, how much this is a story throughout. But Tom, it's not just the retailers, right? We're seeing other stories too on the margins underperforming.
Yeah, we are. They're underperforming. You know, I think it's going to be interesting to see on tech as well. Lisa, you want to go all Cisco here? Why don't you bring in Mandeep Singh? You know, you got some things you want to. I don't care, but
well,
you know,
sure. And fair enough. There are a lot of people who don't care.
You love the pandas. You know, you're an envoy of friendship. Bring in Mandeep.
GIFs I got or GIFs this morning of me as a panda rolling around after your comment.
Well, you're an envoy of friendship.
Okay, moving on to Cisco and this question of consumer spending, but also business spending. Those shares significantly lower after reporting worse than expected earnings, seeing potentially the biggest losses in 18 months. Mandeep Singh of Bloomberg Intelligence, how much is this a Cisco-specific story, and how much is this a broader retrenchment in business development, business spending, even in the hot artificial intelligence areas and cloud?
Well, so that's where if you parse through the print, you can see Cisco is more exposed to traditional networking. And right now, every enterprise wants to invest more around generative AI, where NVIDIA not only provides the GPU chips, but it also has an InfiniBand networking component. So I think the Cisco print does throw into the fact that, you know, IT spending overall is decelerating, but clearly enterprises have picked the areas where they want to invest in, and that's the GPUs and the associated networking around it.
I want to focus here out to NVIDIA. I don't know beans about NVIDIA other than I got one of their fancy chips in a fancy computer at home that I use in music. I want to focus, Mandeep, on the NVIDIA earnings next week, which to me have an importance like Apple earnings or Microsoft, even though it's a much smaller company. Tim Bradshaw does a tour de force in the FT today on the NVIDIA A100 chip, in the H100 chip, whatever it is, and everybody's out there going, we got to build the next NVIDIA. Can Microsoft succeed in cloning or improving upon the miracle known as NVIDIA?
Well, so look at how NVIDIA has built its data center business. It's over the last 7 years, and now it's at a run rate of $50 billion. They were a gaming chip company, and they focused on ARM architecture, really tried to focus on providing something that is not given by Intel CPUs. And I think what they have done is found use cases time and again, whether it was crypto and now AI. I think Microsoft core business is still public cloud. They want to be the Switzerland. They don't want to be in the business of making chips.
Let me sum Ed Ludlow's work at Bloomberg Technology, what Bradshaw's doing over at the FT, with the brilliant work of Anurag Rana and you at Bloomberg Intelligence. This is a technology chase. It's almost like the space program. Do you have confidence that Microsoft, AMD, and the rest can succeed in cloning NVIDIA?
Well, so from my perspective, you need three things for Gen AI. You need the chips, you need the distribution, and you need the LLMs. What Microsoft LLMs, the large language model, whether it's GPT or BARD or something.
Yeah. Large language model is when Pharaoh gets angry at me because I talk too much. Continue.
So I think what Microsoft has is the distribution. What Google has is all three of them. They have their own large language model, they have the distribution, and they are making chips as well. Microsoft's, I think, positioning is good right now because they partnered with one of the earliest ones to build that LLM, and they clearly have the distribution. I think building chips isn't the core focus right now, but clearly they want to hedge their bets.
You know, Tom mentioned something earlier that I think is really apt, which is the winner-takes-all kind of mentality. Is that what we're seeing right now in the tech space, in the chip space, with the miss maybe of Cisco that's being heavily punished and the incredible success of NVIDIA as it consolidates its power.
I mean, look at the kind of run that Intel had over the years after they had the CPU. They had a 25-year run, and to date, they still have the 80% plus market share on the CPU side. It's just they missed it on the GPUs, and that's where I feel because a lot of these training environments are standardized on NVIDIA, NVIDIA will remain the incumbent. There will be an ecosystem built around it.
One more here for you. What are you actually going to look for from NVIDIA next week?
Just how are they looking to expand beyond the GPU chips? Because we know the chip business is very cyclical. There will be a digestion period. Right now,
do they do guidance? Like, is there like...
They do.
We're going to do 2024, whatever guidance.
And they not only beat and raise, they beat and raise by a lot, which is what has happened for the last 2 quarters. They raised their guidance by almost $2-3 billion. So clearly they have set a high bar, but maybe they can top that again.
To what Lisa mentioned here, and I go back to an arch essay by Michael Maboussian at the time at Credit Suisse on this, and I'm not going to go into the electrical engineering of it, but it devolves down to very few people win. Is that what we're living with the Magnificent Seven? Is what Maboussian wrote about 20 years ago?
I think given the scale of these companies and the distribution they have, data is what is you need for AI. These companies all have a lot of data. And if you want to constantly train your models, be ahead in terms of, you know, the AI aspect, these companies, the incumbents, have a clear advantage. Now, there will be somebody new who develops a use case. I think there will be more disruption on the application side as opposed to the infrastructure side.
Mandeep Singh, thank you so much. My brain hurts.
No, that's a good point, though.
Tough.
The application versus the hardware, meaning that the chips are going to be a much higher bar to break into. But if you come up with some sort of ChatGPT new version that has the programming that's that much more brilliant to write your papers in high school, then great, it'll get adopted.
We called that Cliff Notes. Thank you. Here's ChatGPT. I'm sorry, Mandeep, you know this. I'm nuts about the chips that are in here. Are these new NVIDIA chips, are they as dynamic as what we're seeing here? Are they like way beyond this?
Well, clearly, you know, a server chip is a lot more powerful than what is in your phone. And so clearly what NVIDIA has done isn't scalable because we are talking about a chip that's magnitude more powerful than what you have in your phone.
We got to go. We got to talk about pandas. Mandeep Singh, thank you so much. Pandas loving the bond market today. I mean, come on, 7 basis points? I mean, we got something going here.
One of our viewers pointed out that a panda is in fact a bear, so it actually does work. Are they actually bears?
Are they nice? I mean, Steve Roach was at Morgan Stanley with Ellen Zentner. Steve Roach, he would go to Chengdu just to go, you know, climb up in the mountains.
If you are just joining the program, the reason why we're talking about pandas, the sensible reason that we're looking at pictures of pandas is because Xi Jinping said that they would send new pandas to the United States for panda diplomacy after removing the other ones and, you know, seeing the boxes as they sort of were shipped off. You know,
this is like an outtake from Blue-Eyed Samurai. That's what it looks like to me.
Why are we doing this?
On radio, our
like
sympathies. We had to do panda shots. It boosts ratings. I mean, what can I say?
The panda lobby is
We're
wrong.
your envoy of friendship. If you choose, stay with us through the day. And then tomorrow, Mohamed Alarian scheduled to be with us. Coming up on Bloomberg Television, U.S. Ambassador to Japan, Rahm Emanuel.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority. Venture capital. It's been volatile. From bank crisis anxiety to AI exuberance, Caroline Hyde and Ed Ludlow chat with the biggest names about the latest tech trends.
Is AI going to dominate the earnings narrative for this sector this week?
I think we're seeing opportunity and potential platform shift that we haven't seen in a long time.
If you're a company today and you're not embracing the changes that are taking place with AI,
you're going to be behind.
How do you prove to the investor base that you haven't just tacked on AI to make yourself sexy?
It's very hard to differentiate if you're not experienced with AI.
The startup stories.
We think this is a watershed moment for technology.
Certain categories are more exciting than others. Right now, obviously, generative AI is a category that is very exciting to startup founders, customers, and venture capitalists as well.
So what we are seeing is a new area of opportunities for new founders to come and change the industries that matter.
And the real talk on realistic valuations.
Some of the best opportunities are sitting right in front of us.
How do you discern which ones are good on the marketplace right now?
I think founders have woken up to the reality that taking on more money at higher terms doesn't necessarily play to their benefit in the long run.
How do you actually invest?
Follow the VC money on Bloomberg Technology, the only daily business show dedicated to tech right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television.
So let's go inside the boardroom. Let's suppose you win a proxy fight and/or you just get invited onto the board. You go to your first board meeting, and you're the person who's saying you can fix this company, and all of the others on the board of directors are saying, well, we're doing pretty well. How do you get received when you start saying, here's what I wanted you to do?
Well, first of all, we don't bring that to the boardroom. Our time is spent with the CEO, the chairman, the CFO, and share our plans with them outside the boardroom. We try never to solve an issue in a boardroom. Okay, it's always best done the day before, the week before, outside of that room. We wouldn't be there if they really were doing well. So it's really hard for them to straight face and tell us we're doing well. And we present it with the plan.
This is Bloomberg.
There's just a little bit of consumer weakness out there this morning. Live from New York City. Good morning, good morning. Equity futures just about positive on the S&P. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Farrow.
Live from New York, coming up, Walmart delivering a cautious outlook as Fed officials refuse to declare victory, and Biden and Xi's meeting delivers small wins. We begin with the big issue, retailers facing slowdown fears.
There has been a little bit of bite that we have seen on the consumer.
Seeing those cracks in the consumer show up more readily.
When we look at retail sales from a real perspective, adjusted for inflation, volumes are still declining.
When we look at the credit card delinquencies numbers, the auto delinquencies numbers, those are picking up ever so slightly.
Retailers certainly need higher volume to kind of get to the numbers that they want.
If we look back at Q3 earnings guidance from a number of companies,
the consumer is tapped.
Their wallet is very much under pressure.
A key trend that came through was the fact that consumers are under increasing pressure.
The American consumer does have the propensity to spend.
Continues to spend.
When consumers have jobs, they will continue to spend.
The labor market is the catalyst for it.
Will this holiday season be a source of upside surprise or downside surprise when it comes to consumer spending?
The real question is are we going to have a slowdown?
It's all about the consumer.
It's all about the consumer this morning. Joining us now to discuss this, Nuveen's Tony Rodriguez, Mike Contopoulos of RB Advisors. Gents, we've got to start with Walmart. It's down by about 6% in the pre-market. This quote from the CEO on the earnings call, this line here, we may be managing through a period of deflation in months to come. Tony, how do you respond to that one this morning?
Well, good morning, Jonathan. Good to be with you. I certainly don't expect we're going to be in an environment of deflation. I understand that from a perspective of the largest retailer in the country, they are certainly looking at the next couple of quarters, and there's some pretty significant headwinds from our perspective in terms of consumer spending. And we think that kind of the segment of the market that Walmart is strongest in, some of the lower income areas, those consumers are going to be the most stressed. So not surprised to see Walmart talk about some cautious outlooks ahead, but certainly the word deflation is not something that's in our lexicon as we look at the next couple of quarters for the U.S. economy writ large.
Tony, is it across all income groups? It wasn't just Walmart this morning with a bit of a warning going into the end of the year. Burberry with some dreadful numbers in London. That's a luxury player. That stock's getting hammered. Is it across all income groups?
I do think it's across all income groups. The lower income groups are probably the most supported by the very strong labor market, and we're starting to see a little bit of a softening in that. I'd still call it solid. It's just not red hot anymore. So it is across all income groups, and it's going to be a relatively slow playing phenomenon. We don't expect to see the consumer fall off a cliff, but we do think these headwinds of not only the higher prices they're facing because of inflation, but now, student loan payments are hitting, higher cost of financing for a variety of durable goods are hitting, and we do see this softening in the labor market. So that combination is really going to affect consumers across all income spectrums. But again, we're not expecting it to fall off a cliff. We think it'll moderate slowly over the next couple of quarters.
Let's talk about that cliff. Mike, you've said for a while, stronger growth now means a harder landing later. Is that still the case for you?
Yeah, I think that's absolutely the case, Jonathan. The question is just when is that harder landing ultimately going to materialize? I just don't think this cycle is that different than past cycles. And if you actually think about it and you look back at the data, it's kind of played out exactly as you would have expected. I mean, we had a lot of weaker economic data earlier this year, and then around summertime, it started to reaccelerate again. And we're in that reacceleration phase at the moment. Now, that doesn't mean, we're off to the races. We're going to be at 6% or 7% GDP growth, but nominal GDP growth is still quite strong. The labor market, with an unemployment rate of only 3.9%, suggests that the consumer is still somewhat healthy. And so I think before you get that next downturn, which will likely be a deeper downturn, you still have some runway here for growth. So I don't think this is an imminent sort of recessionary scenario that we're living in. But when it happens, yeah, I absolutely think it's going to happen just like past cycles, and it's going to be pretty deep and hard. But that might not be till the second half of next year or even 2025 at this point.
Well, that's what equity bulls are hoping for. Michael, I'm just looking at some of the moves this week. Buying discretionary real estate, the equity market absolutely surging after that small downside surprise on CPI on Tuesday. Are you ultimately saying, though, Mike, that the dream of painless disinflation is one you should think about selling in 2024?
Yeah, well, I mean, listen, I think, that might actually be the case. We're pretty constructive on equities, particularly cyclicality, whether that be energy or industrials or small caps. But we're also cautious when it comes to credit. I think we're living in a late cycle economic environment and maybe an early to mid cycle profit environment. And that makes things tricky here. But the whole, immaculate disinflation story, I think, is a far stretch. I mean, either we're going to have stronger than expected growth or we're going to have a hard landing. And at RBA, we think it's the latter first, stronger than expected growth for maybe the next 3, 6, 9 months, followed by some sort of traditional recessionary scenario. And that typically means you have to be a bit more nimble, a bit more tactical, and a bit more open-minded as the data comes in and suggests, how you want to be positioned.
Tony, are you on the same page?
I would say we're not entirely on the same page in terms of we do think that there's a reasonable probability that a soft landing or a milder recession is actually what we see kind of in the middle to second half of next year as opposed to the hard landing. Certainly the risks are there for a hard landing, but we think that there's, certainly a pretty sizable chance that we avoid a hard landing. We're not expecting reacceleration. So we do think we'll see positive growth next year, but we think it's going to continue to moderate. So the story there is that, consistent maybe with Mike is saying, we're very, cautious on very, very low quality credit, for example, the CCC space, the very low single B space across asset classes. But when we look at higher quality, below investment grade assets, there we think we have company we can find that are going to be resilient from a cash flow perspective, interest coverage perspective, and attractive total return perspective for clients. So those areas of the credit market we are comfortable shopping in, but we are cautious on the lowest quality segments.
That's the credit market. Let's look at equities. Equity futures just about unchanged going into the opening bell, about 25 minutes away. Tons of economic data this week. CPI on Tuesday, retail sales yesterday, this morning, jobless claims. Mike McKee, jobless claims just starting to inch a little bit higher.
just starting to inch a little bit higher, suggesting maybe the labor market is loosening up as the Fed expects, but we're also in that period when it's hard to get a clean read on claims because of holidays. But they do rise by 13,000 over the last week to 231,000, and perhaps more important for some analysts, 1,865,000 continuing claims compared to 1,833,000 the week before. Immaculate disinflation, though, take a look at what we got from import prices, down 0.8%. We're now negative 2% for the past year. Without oil in there, it was down 0.2%. So we're still seeing a decline in what we're buying from overseas. A little bit better news from the Philadelphia Fed, but not great. However, their prices paid index does go further down to 14.8 from 23.1. It's the claims and continuing claims that people are watching because they want to know if we're going to see higher unemployment. And it is certainly possible. Continuing claims have now reached the highest in a year. The question is, if we get a rise in unemployment, does it keep going or not? And that's going to be the question for the markets ahead. Right now, the markets are, and I'm going to quote a British policymaker who said today, they're not clocking on to what the central banks around the world are trying to say. Take a look at where we are with Fed funds futures. We've priced out, zero, literally zero now for the next two Fed meetings. Maybe we don't need to show up. And then the first rate increase in June, but we're also getting a little bit closer to that in May. So we'll see how the data keep unfolding and whether the markets put more pressure on the Fed. And I guess, John, it'll depend on whether or not we do see unemployment go up and inflation continue to drop.
Precisely. Mike McKee, thank you, sir. 2 points there, the economic data and what it means for policy. Tony, let's go to the economic data. This is what Mike Kontopoulos and I were talking about just a moment ago. The dream of painless disinflation. Tony, is it just that? We've had the disinflation. Is the pain just around the corner, specifically in the labor market?
Yeah, well, we definitely don't think you'll see painless disinflation, but we do think inflation will continue to decline, and we do think unemployment is going to continue to rise. I think the big key is, do you see unemployment rise into the 4 to 4.5% area, and that's where it peaks out, or does it continue through that level up to what is a more traditional rise in the unemployment rate in a slowdown / recessionary environment, which is at least 2 percentage points, so we're talking about 5.5%. We do think that there are some conditions in this current cycle that might indicate that employers are going to be a little bit more reluctant to let go of labor given the recent issues they've had with trying to hire back a skilled labor force. So in our view, we might get to around a 4.5% level. That's consistent with this slowdown that we're expecting in the economy, the ability for the Fed in the second half of next year to pivot to maybe cutting rates, probably not as aggressively as the market is currently pricing in, because we don't believe in this immaculate disinflation. But we do think we're going to continue to move lower on inflation, higher on unemployment, and slower on economic growth over the next couple of quarters.
Tony, what you just said, though, is really important. We've got equity bulls this week really bulled up on the idea that this Fed can reduce interest rates sometime soon. Why the second half of 2024 for you?
So it has to do with our belief that we're going to have stickier inflation. So the Fed, I think, is going to be very focused on trying to keep the real Fed funds rate in restrictive territory, but not have it become more restrictive as inflation declines. So the more you think it'll be a rapid decline in inflation, the more flexibility the Fed will have to cut rates more aggressively. We think inflation will be a little stickier, won't come down quite as quickly, and that's going to allow the Fed to cut rates maybe 3 times in the second half of next year versus the 4 cuts that are currently being priced into the market. So we think the market's a little bit optimistic on the Fed's ability to respond in 24 with cuts.
This has been a big topic of conversation for us through the week. This market wants to declare victory over inflation. This Federal Reserve does not want to go there. San Francisco Fed President Mary Daly speaking to the Financial Times, to Colby Smith, saying this: we need to be thoughtful, need to take our time, not rush to judgment, and not make any declarations. Mike Kontopoulos, are you in the same camp? If we get a reduction of interest rates, when is it going to land?
Well, I'm not entirely convinced we're going to see a reduction in interest rates anytime soon. I think it's too hard to sort of forecast, in the back half of next year. We just don't know what's going to happen between now and then. I mean, I think for every reason to expect lower inflation that we've gotten more recently, you can come up with a different reason to expect higher inflation. And of course, there's been a number of head fakes over the last year. So I'm not prepared to make a call on when the Fed is necessarily going to cut interest rates. But where I'll disagree a little bit with Tony on is that because of the sort of structural labor shortage that we're seeing, I think it's going to be very difficult to get to 2% inflation with an unemployment rate that only goes to 4.5% as an example, which you would kind of classify as a very soft recession, which I would agree with. I just don't think you can get to 2% with another 60 basis point rise in unemployment, particularly if you're drawing people back into the workforce. And that's sort of where we sit. It's that in order to really get to the Fed's mandate, you almost have to bring the unemployment rate north of 5%, which by definition then implies the hard landing. The problem is that might be much later than what most market participants expect. And so not really prepared to make a call on when the Fed's cutting, but my guess is it's going to be later than the market expects rather than earlier.
So, Mike, I hear two calls from you, one more near term and then one out in the future. I'm not sure where it lands, but ultimately the near term sticky inflation converging maybe towards 3 to 4% on CPI and not down to 2. And then further down the road, there's got to be some kind of economic reckoning to get inflation down back towards target. With that in mind, Mike, if you've got a bond market call right now, does that mean, in the near term at least, there are limits to how far this bond market move can go?
Yeah, I think there is. I think we're going to be very range bound, Jonathan. I mean, I could see 4% on the 10-year, and I could see us back up at 5% on the 10-year. And so, our view is that's just not the time to take a lot of interest rate risk here. There's not a tremendous amount of downside, but there's also not a tremendous amount of upside. So you might as well try to find your opportunity elsewhere. And the good thing is unlike in the beginning of the year where kind of cash was king and that was the obvious place to be, there are other opportunities, whether that be through curve trades, whether that be through things like preferred securities, whether it be through AAA CLOs or agency mortgage-backed debt. I mean, there are opportunities out there in fixed income where you don't need to take excessive interest rate risk at the moment to get a nice total return. And so given this uncertainty I've kind of laid out, especially on the timing, I think that's the way you're supposed to play and be much more neutral on the interest rate side.
We'll continue this conversation. Tony Rodriguez alongside Mike Contopoulos. Your equity market right now pulling back just about 0.1% on the S&P. Let's get you some movers going into the opening bell. Here's Abby.
John, beneath that relatively benign surface, we have some big name laggards, starting off with the shares of Walmart. They are down more than 6%, at least the last time I took a look. And yes, they still are. And they put up an inline quarter. They actually raised slightly, but it's the color, the composition. The company is saying that in late October, there was less demand. This is actually consistent with what Target said yesterday, that they are cautious on the near-term consumer, but investors not liking it from Walmart, which has produced so many good results this year and into today, up more than 15%. Palo Alto Networks, the cybersecurity company, their first quarter billing missed, and the guidance on the year for billings missed. That stock also down sharply. And then Cisco plunging down 11.1%, the biggest drop in about 18 months. Their quarterly outlook well short of analyst estimates. Investors clearly not liking that at all, John, with Cisco down 11%.
Abby, thank you. More from Abby around the opening bell in about 15 minutes' time. Coming up, President Biden and Xi attempt to play nice.
The United States will continue to compete vigorously with the PRC, but will manage that competition responsibly so it doesn't veer into conflict or accidental conflict.
Those attempts overshadowed by one single word. That word up next.
Are facing some tough challenges. Higher living and education costs and wages that aren't keeping up with inflation are making it harder for them to support themselves. And and they're relying more on the bank of mom and dad. A new bank rate report shows nearly 70% of parents with kids 18 and older are putting their own finances in danger to help them. About half are dipping into their emergency savings or delaying paying off debt, while 43% drain their retirement funds. So where do you draw the line? There seems to be a generational gap, as older parents can't understand why being self-sufficient now is a lot harder than it was for them. Gen Z seems to think on average that 22 is a benchmark for covering the expenses, while baby boomers say their adult children should pay their own way closer to age 20. Either way, it's a family decision. Bankrate suggests having a conversation with your kids and setting a specific dollar amount or time frame for footing the bill.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point, what is the lesson or the observation?
I believe these are some of the most constructive and productive discussions we've had. I've been meeting with President Xi since both of us were vice president over 10 years ago. Today, build on the groundwork we laid over the past several months of high-level diplomacy between our teams. We've made some important progress, I believe. The United States will continue to compete vigorously with the PRC, but we'll manage that competition responsibly so it doesn't veer into conflict or accidental conflict.
President Biden and President Xi playing nice, agreeing to restore high-level military ties, crack down on fentanyl and more, but much of the progress overshadowed by Biden's comments to the press.
And Mr. President, after today, would you still refer to President Xi as a dictator? This is a term that you used earlier this year.
Well, look, he is. I mean, he's a dictator in the sense that he is a guy who runs a country that is a communist country that's based on a form of government totally different than ours.
The Chinese Foreign Ministry calling Biden's remark, quote, extremely incorrect. Bloomberg's Anne-Marie joins us right now for more. AMH, we were playing nice, the pandas are coming back, and then that. Does that really change anything?
I don't think it does, Jonathan. Listen, President Biden has said this before, and he'll probably say it again, calling Xi Jinping a dictator. Obviously, it irked China, and they felt the need to respond to this. But then Xi Jinping went to a very warm welcoming and greeting amongst America's biggest executives, the titans of American business that he sat down with. And he said there he does not want China to be in a hot war or a cold war. He also says he does not want to unseat the United States. When it comes to the fact of the matter is, Jonathan, leading up to this meeting, we saw reports in the tea leaves of what the tiny, small deliverables would be, whether it be Boeing, whether it be fentanyl, whether getting back to that normal military-to-military communication that was really ripped apart when Speaker Pelosi went to Taiwan. But the main deliverable was that the leaders of the two biggest economies, Jonathan, sat down in San Francisco. And I don't think this comment, frankly, is going to overshadow any of those small deliverables, because the fact of the matter is, Biden has said this, and as we gear into the 2024 election, Jonathan, the rhetoric is about to get much hotter.
Without a doubt. AMH just taken down the heat in the last 24 hours, or at least attempted to. Anne-Marie, great work the last day or so on the West Coast in San Francisco. I want to revisit a quote from Peter Chi of Academy that we talked about in this program just yesterday, when he said, be prepared for the meeting this week to come across as highly conciliatory, prompting an everything rally into year-end. We don't even need to see concrete actions taken. If the messaging is strong, that messaging should be enough to get the job done. Final thoughts now. Tony Rodriguez, Mike Contopoulos back with us. Tony, a lot of people talk about this cash on the sidelines on Wall Street, this cliche type stuff. Can we talk about the money in money market funds? Tons of it, Tony. What would it take to unlock that?
You know, Jonathan, probably one of the things it's going to take is FOMO, fear of missing out on the market. And when you look at the last couple of days, 2 weeks, that is a perfect example of how quickly the market can reverse. It seems like only 10 seconds ago we were at a 5% 10-year. Now we're in the 4.5%, just below area. The total return available there, if you look at a variety of fixed income asset classes, just month to date, you're talking about 2.5% to 3% returns, significantly outpacing cash. So we think that the opportunity that they may leave on the table by sitting in a money market fund is really quite high, as we're expecting to see a decline in interest rates, a slow, steady one through the middle of next year, where you're going to wake up, 10 years going to be sub 4%, and there's going to be some significantly stronger returns across multiple areas of fixed income than had you been sitting in cash. So I think as that realization comes through to clients out there, they will begin to put money to work. And in fact, some of the biggest risks have been moderated somewhat as the data has come in, not pointing to a Fed that has to re-accelerate tightening, but in fact can soon in the middle of next year pivot to cutting.
It's a really important question, Mike, because a lot of people sitting at home listening to this program right now are sitting in cash. They were told to. They got money for it. They got yield interest in a way that they didn't for a long, long time. What should they do now, Mike?
Yeah, Jonathan, you know, I talk a lot with financial advisors and their clients, and these are some of the, you know, believe it or not, the smartest investors that are out there. And they put their money in cash, and that's been actually the right trade for much of the last 2 years. And so I think kudos to them. And, you know, I think we got to give them a lot of credit to understand when to extend duration, when to find, you know, return in other products. And I think we're coming up on that point now. I mean, most folks are looking at the yields available out the curve and the total return potential in other products like agencies, as I mentioned earlier, preferred securities, and they're starting to get excited about it, particularly given that the equity market, ex-Mag 7, hasn't really done a whole lot for them. And so, you know, I think we're nearing that point. You know, once the Fed does start to cut, whenever that is, you know, obviously those cash yields are going to go away. That's where you're going to get the biggest movement to the rest of the fixed income market. But I think between now and that time, you're going to see a steady flow of money coming out of money market funds and preferred deposits and the like into more traditional fixed income.
There's a lot of money in those funds, that's for sure. Mike, thank you, sir. Alongside Tony, to the two of you, thank you. Coming up, morning calls, and later, Walmart falling from record highs, delivering a cautious outlook.
Thing in life I've often said is to be happy, but you seem like a very happy person.
It's like nature. Nothing ever stops. So you could be super happy 1 minute and then something happens. So it's just living. It's the joy of life.
For any young woman that's watching this, wants to be the next Diane von Furstenberg, what would you recommend?
I think the most important thing in life is the relationship you have with yourself. Once you have a good relationship with yourself, any other relationship is a plus and not a must. And the second advice is to be as true to yourself as you possibly can. And you have to accept and own things you may not like, but the more you could be you, the happier you will be.
Could face bigger challenges next.
Fed was going to keep rate World Cup. This is a 3.
As the economic picture does.
The OK is getting ready to make a decision.
From the opening bell, let's get you some morning calls. First up, Mizuho upgrading Intel to a buy, expecting shares to benefit as the company launches its new server products. Citi downgrading Plug Power to neutral, saying management subpar execution has led the company into liquidity challenges. And finally, TD Cowen downgrading Target, expecting stretched consumers to pressure near-term growth. Coming up, Walmart sounding the alarm on the US consumer. That conversation up next with BlackRock's Amanda Lynham, your opening bell, just around the corner.
Back in 1997, I was interested in the following question, which is, there are a bunch of the dinosaurs called sauropod dinosaurs, which had really long, skinny necks. So Apatosaurus is an example. They also had really long, skinny tails. So I made a computer model that showed that, in fact, the tail of these sauropod dinosaurs could actually act like a whip. A bullwhip. Now, the way a bullwhip makes that cracking noise is because the tip of the whip actually goes about twice the speed of sound. Okay. I think the way they got a date was to impress the females by making loud booms.
News breaks. No one covers the world like Bloomberg.
On the AI question, what we don't really see is Apple doing a knee-jerk response and moving into the domain of generative AI.
Supporters of President Recep Tayyip Erdogan celebrating late into the night, dancing and singing.
We have a fundamental reassessment of everybody's capacity within OPEC. Should we talk about $95 and $100 oil again? Not for a while.
Bloomberg, your global business authority.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
This is Bloomberg.
Let's get right to it. 25 seconds away from the opening bow this morning. Good morning to you all. Just a touch of weakness out there in the data, in the commentary around the earnings. Jobless claims a little bit higher than expected. Walmart with a cautious view on the consumer going into year-end. Equity futures pulling back just a touch. We're down about 0.2% on the S&P. There's your opening bow. Switch on the board and get to the bond market. What a few months it's been for 10-year treasuries. A week ago today, in the morning, a week ago Thursday, the 10-year yield opened up at 448. All the volatility in between, and look where we are, 447.26. Yields are lower by 6 basis points. The euro showing some strength, bouncing back to 108.64. We're up by 0.15% on that currency pair. Elsewhere, crude pulling back 2.7%, down to $74.60. About 30 seconds into the session, we're pulling back just a touch by 0.1% on the S&P, down by 0.3 on the Nasdaq. One stock to watch all morning, Walmart, the retailer, sounding the alarm on the US consumer after signs of weakness at the end of October. Abby has more. Hey, Abby.
Well, this is really an interesting one, John, because we do, of course, have the stock down sharply, down more than 6%, heading to its worst day since July of 2022. And the quarter that they put up was basically in line, and they actually raised the guide just just slightly. The increase of 7 to 7.5% in operating income, a little bit little changed, and not quite as much perhaps as some folks had wanted. But it's that color that you were talking about, the idea that at the end of October there was a demand weakness. Now it did rebound apparently in the beginning of November, but they're talking about that around the holidays. So they're kind of cautious here on the consumer. They're saying specifically that we are more cautious on the consumer than they were just 90 days ago at this time. Also making this super interesting, at least to me, Target said something very similar yesterday, but Target going into their print yesterday, and it was a blowout in terms of adjusted earnings. That's not the case here for Walmart, down 25% on the year. Walmart coming into today up 20%, outperforming the S&P 500. You add on this color that, again, is not all that different than what Target said yesterday about being somewhat cautious about the state of the consumer, having to do with interest rates and student loan repayment. Well, the stock is down 6.6%, John, the worst day since July of 2022.
158 this morning. Abby, thank you. Let's go back to that quote from the Walmart CEO on the earnings call. In the US, we may be managing through a period of deflation in the months to come. That's something we all need to think about in the weeks and months to come, beyond just equities, beyond Walmart, for the broader bond market as well. Let's stick with retail earnings. Very different outcome for Macy's this morning. Topic, profit estimates, thanks to improving inventories. Katie Greifeld has this one. Hey, Katie.
Well, Macy's is rallying hard on the heels of that report. You take a look at shares right now, up double digits. After beating on profit, you saw adjusted earnings per share come in at 21 cents. That is well above the average analyst estimate of 0 cents. So again, a beat there. You also saw gross margin come in just above 40% thanks to fewer product promotions. And an interesting wrinkle in this report was the drop that you saw in same-store sales, a third straight quarter actually of declines. And if you think back to what we saw from Target yesterday, this is a developing trend among the retailers. Basically, you see improved profitability, but falling comparable sales. Again, saw a similar thing with Target. And it's difficult really for these retailers to maintain that sales growth that they enjoyed during the pandemic. It looks, though, that investors will take the improving profitability, though. Macy's up about 11-12% right now, should be its best day since June.
Katie, thank you. I said this a little bit earlier this morning. It's like the best and worst of it with earnings. You can cherry pick a story, just pick a couple of companies and say whatever you want. Pick on Walmart, Burberry this morning, and talk about a consumer slowdown. Take Macy's, throw in Target yesterday, and you can talk about retailing stocks doing nicely. Let's talk about one that's doing okay. Williams-Sonoma reporting results that surpassed expectations, but cutting its net revenue forecast for the full year. Simone Foxman on top of this one. Hey, Simone.
John, both you and Katie were talking about this same story, slowing sales but higher profitability. That's exactly what we saw at Williams-Sonoma as well. And traders, this was actually initially down immediately post earnings in the pre-market, but now we're a little bit higher. The company cutting its full-year revenue forecast, expecting revenue to fall 10 to 12%. It had initially expected this to drop 5 to 10%, but raising its overall guidance for profits on margins, now seeing 16 to 16.5%. Versus Wall Street's expected 15.3% for the full year to come. In the third quarter, it was already the same story. We saw margins at 17%, a couple points higher than the estimate. And we saw profits beat, but comp sales were down substantially, down 14.6%. Revenue missing estimates down 15% year on year. And this really felt across all of Williams-Sonoma's brands. CEO Laura Alber in the statement talking about an environment filled with ongoing consumer hesitancy on high-ticket discretionary furniture spend. Remember those high interest rates, also elevated levels of promotional activity. We are looking at shares well above 40% up for the year to date. And on the 10 a.m. call, we're going to look at indications of holiday spend, also the impact of higher rates, as well as just broadly a weak home sector, John.
Ismail, thank you. Let's get to a name that's really struggling this morning. Shares of Cisco. Cisco's down about 12.5%, potentially.
That just happened, or the fiscal second quarter, which for Cisco is the period ending in January. What they said is that sales would be between $12.6 to $12.8 billion in the quarter ending January, but the Street's forecast for that period was $14.2 billion. So this is a pretty big miss in expectation. What they said was that in the last 6 months, they have shipped against a backlog of network gear orders. In other words, some of the biggest enterprise customers finally took delivery of equipment that they've been seeking for quite a long time. As a result of that, Cisco has done well over the next 6 months, but what those companies or enterprise customers will now be doing is installing and utilizing the orders they've already made. There's a difference of opinion between the street and Chuck Robbins and Cisco CFO as well, which is that the narrative from Cisco was they see sales accelerating again once customers have worked through installing that equipment. The concern, and there is a difference of opinion on the sell side here, is whether this is indicative of a broader down cycle for networking gear. One of those names being Piper Sandler's James Fish, who will be on the show with me later today. But a big drop, as you said, we're down more than 12%, on track for the biggest drop since May of 2022, or in other words, the biggest decline in around 18 months.
Ed, stick with me. Looking forward to the show a little bit later. No doubt you'll be talking about Cisco, maybe even Alibaba. Let's bring that name up. That stock is getting absolutely hammered. It's down about 10%. Ed, I'm sure you've been following this story. Calling off the spin-off of its giant cloud business. Ed, what are your thoughts on this currently?
Yeah, there's a lot that's an analogous between Alibaba and Amazon for obvious reasons, right? It is principally to the outside world an e-commerce platform. What they've been able to do less of is turn the cloud business into the cash cow that Amazon was able to do with AWS. And as you know, they're looking at each individual unit for potential spin-off to isolate it and help it to grow at a faster click. Stalling on those plans, but also the growth narrative around their cloud business seems to be the principal concern this morning, and I think the ADRs are down almost 10%, so that kind of tells you everything.
Down 9.8. Ed, thanks for that. Appreciate the update. About 8 minutes into the session, broader market looks like this, down about 0.1% on the S&P, down 0.25% on the Nasdaq. Joining us now to continue the conversation is BlackRock's Amanda Lynham. Amanda, wonderful to catch up with you. No doubt you've seen it all week. At times, particularly on Tuesday, equity investors buying absolutely everything. Are you seeing the same thing in credit markets?
Good morning, Jonathan. Thank you for having me. We are seeing a trend of compression in the high yield credit markets, meaning that high yield has been outperforming investment grade, which is notable. I mean, we've been tracking high yield spreads, as you know, and they're now notably below 400 basis points. And I would say a decent chunk of the high yield market is actually even much tighter than the index level. Over half of that index is 100 basis points tighter than the index spread. So what does that mean? That means that investors are looking for risk, but there's a limit to their appetite, and triple C's lagging has been a constant theme over the past few weeks, even despite this broader risk-on tone. So the capital markets are open. We've definitely seen inflows into the asset class, but triple C's really can't seem to catch a bid, and I think it's really indicative of this challenging position of a subset of the market that has weak fundamentals, but then also near-term refinancing needs. And I think investors are kind of drawing a line into how far down the risk spectrum that they will go, and that's true for both high yield and loans. You're seeing it in the consumer as well. I know you've been focused very much on the retail sales dynamic and the consumer, and even with the consumer, the New York Fed had some really interesting data out recently, which showed that the main pressure point for credit card delinquencies is really lying in that consumer that has both auto loans and student loans. And so similar to the corporate market, where I would say there's generally a feeling of decent health, that's our view on the consumer as well, that the high-end consumer has been doing a lot of the heavy lifting in terms of spending. But when you drill down into the lower income cohorts, specifically those with multiple types of debt, there's really a vulnerability there.
There's a ton to unpack there. Let's just go through it piece by piece. Amanda, when you see high yield outperform IG and within high yield, triple C's lag, do you think that speaks to maybe the temporary nature of this particular rally this week, that within credit there's a belief that perhaps the good times don't last?
I do think actually there can be some stability in high yield spreads if we do manage to pull off a soft landing. I think the scope for material spread compression in high yield is probably limited, but I do think there is a case for stability in high yield. I think what you're pointing to, Jonathan, is really the market's hesitancy with respect to these really low quality firms that have clear refinancing needs, because we just haven't seen that price discovery process in the new issue market for that low end of the credit spectrum. Most of the issuance that we've seen so far this year, it's been light and it's been skewed towards the higher quality, higher rated firms. And so for firms that have refinancing needs, I think the market is just a bit hesitant to see where actually the clearing level is for that refinancing, and is that something that is economically viable for that company. We had the most recent data for defaults from Moody's out overnight, and we're seeing a continued uptick in the default rate in the U.S. corporate market. Again, leverage loans, floating rate borrowers are doing the heavy lifting of that default rate, but it's still climbing. We haven't seen that plateau yet, and I think that's exactly what the market is focused on.
We have visibility on those financing needs. We understand where that maturity wall is. Can you walk us through it? Just where is that window? Where do you think it lands on the calendar into next year?
Sure. So we're really expecting this activity to be window-based and episodic. Really, the maturity wall starts in 2025. It does not let up until 2029. So there's a pretty steep mountain that those firms need to climb. Typically, high-yield companies don't like to let their debt become current or due within 12 months. So it's reasonable to assume that 2024 should be a focus point for these corporates to address those maturities. I think where we would see a pause would be periods of market volatility where corporates just aren't sure that they can execute on a refinancing, or corporates that are trying to be almost maybe strategic about the timing. My view on this, as you know, is that it's better to issue early rather than late, and so I would not be surprised in periods of market stability for corporates to move forward and really start to chip away at those maturity walls, even if they're leaving some basis points on the table, so to speak, in terms of the interest costs.
So, Amanda, the Federal Reserve, Fed officials have come out, Mary Daly in the Financial Times yesterday. They're not ready to declare victory in the fight against inflation. Tony Rodriguez of Nuveen earlier this morning on this program said no rate cuts until the second half of 2024. I think ultimately, Amanda, we've got no idea where those rate cuts land, but let's just say that's true. Second half of 2024. If the Fed's not cutting rates until then, Amanda, can you describe the kind of problem we might see as some of these companies try and come back to market and issue debt?
Sure, and I thought your conversation with Tony and Mike was great, and I would agree with that. I think the bar for rate cuts in the first half of 2024 seems very high. I've been encouraged by the inflationary progress that we've seen with the CPI data most recently this week. I think it eases the pressure on the Fed to hike from here for sure, but Chair Powell has been very clear that they don't want to be misled by a few good months of data. They don't want to be misled by inflation head fakes, and so I do think that they will hold rates in this restrictive policy area. So what does that mean for corporate credit? For the majority of the investment grade market, it's a headwind, but it's incredibly manageable. I would say that's also true for most of the high yield market. But again, the exception is really in that kind of lower quality cohort. So definitely the triple Cs and even the low single Bs. I do think that it's reasonable to assume that the default rate picks up modestly from these levels. So we're hovering just in the low fives in the U.S. high yield market. There's probably some room to go there, but do we revisit the COVID peaks of 8.5% to 9% default rates? I don't believe we do. We certainly, I'm not expecting us to come close to the GFC peaks of 14%. So a modest uptick in the default rate is what we should expect. And then ongoing dispersion across sectors, within sectors, that's been a key theme of the high yield market. We've seen more dispersion in the high yield market relative to its IG peer, which makes sense for exactly the reason that you're noting. So again, I'm still in the camp of this is a catalyst for credit market dispersion as opposed to credit market disruption. But really the key is not just the Fed monetary policy at the front end, which is relevant for floating rate borrowers, but the long end volatility, which I think is also an input to the cost of capital.
Amanda, thank you. Appreciate the update, as always. Amanda Lanham there of BlackRock. About 15 minutes into the session, equities right now basically unchanged on the S&P 500. Coming up, the Senate averting a government shutdown.
I have good news for the American people. This Friday night, there will be no government shutdown.
U.S. lawmakers kicking the can, setting the stage for a busy agenda and spending deadlines in the new year. That conversation up next.
Europe, I'm Kriti Gupta. Let's get to the stories that set your agenda.
Taking you from the U.S. market's close
A lot of this was priced into the U.S. session.
to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
So as you look back on your career, what would you say is the best investment advice you've ever received?
Probably the best investment advice that I never received, but that I've lived my whole life around, is surround yourself with really good people. I thought about it just today, like I do many times, what makes a great investor? A great investment firm is comprised of people who are optimists and pessimists and realists. Because in the intersection of the debates that go across that wide range of personalities is where you find truth. It's part of the reason I'm so focused on freedom of expression. I see it in my own four walls, the robust and fulsome debates around how we commit our capital, what defines a good idea, what businesses to build or pursue. That's what drives the success at Citadel. And I've been very fortunate in life to have always had a group of friends who really push me, who make me better. And here I get to work with 3,500 colleagues who in their ways make me better each and every day. And collectively, as a team, we've had the opportunity to have an incredible impact on the financial landscape around the world.
On the next episode of the Business Week Show, reputation. People say, oh, well, LeBron gave you an opportunity, lucky you did this. But you don't talk about Donald Trump's dad gave him a loan, James Dolan's dad gave him a business. What's the difference?
I try not to care too much about what people think, and if that helps others see that there's more to life than a good reputation, that can be a positive step.
Watch the Business Week Show, Thursday nights, 10:30 Eastern on Bloomberg Television, or 8:30 on Bloomberg.com or the Bloomberg app on connected TVs.
I have good news for the American people. This Friday night, there will be no government shutdown. Thank you. Because of bipartisan cooperation, we are keeping the government open without any poison pills or harmful cuts to vital programs. A great outcome for the American people.
Was it Jeb Bush who once said, please clap? That's what that reminded me of. Majority Leader Chuck Schumer declaring a victory of sorts. The Senate voting to pass a temporary stopgap bill, averting a government shutdown for now. Once President Biden signs the bill, 2 new deadlines loom in early 24. Not everyone is declaring victory. GOP hardliners pushing back against House Speaker Mike Johnson's compromise with Democrats.
One thing. I want my Republican colleagues to give me one thing, one, that I can go campaign on and say we did. One. Anybody sitting in the complex, if you want to come down to the floor and come explain to me one material, meaningful, significant thing the Republican majority has done besides, well, I guess it's not as bad as the Democrats.
Team coverage starts right now. Bloomberg's Kelly Lyons in D.C., AMH in San Francisco. Kaylee, a big fight on the horizon.
Yeah, lawmakers may be able to enjoy their holidays. Everyone's already left for Thanksgiving, in fact, John. But come the new year, it is going to be a reckoning. As you said, there's 2 dates we're dealing with. Funding extended partially to January 19th when it comes to ag, energy, veterans affairs, transportation, and February 2nd for everything else, including defense. The problem is to meet those deadlines, there's going to be more limited options. Speaker Mike Johnson has already said he will not support another stopgap continuing resolution like the one just passed. And it does seem like hardline conservatives in the House are going to hold him to that. That really leaves 2 options. Option 1 being finish the work of passing all of the different appropriations bills. Option 2 being shut down the parts of the government that's funding is running out at those dates. Option one obviously is the preference, but it is going to be very hard to accomplish. As we just heard from Congressman Chip Roy, Republicans really want to see deep spending cuts. At least hardline conservatives would like to see spending cuts that go even beyond the debt ceiling deal that was reached between former Speaker Kevin McCarthy and the White House earlier this year. The problem is deep cuts are not going to fly in a Democratic-controlled Senate and would not be signed into law by President Biden. So trying to reconcile these different priorities is going to be very difficult, especially for Mike Johnson, who already is facing some ire from conservative members of his party and is operating under the same rules that Kevin McCarthy was under, which is one member could bring forward a motion to oust him from the speakership. So come January, John, it's not just going to be a question of will the government stay open, it's also going to be a question of will Mike Johnson keep the speaker's gavel.
AMH, this is going to be so difficult. Run through it. Katie just went through the spending difficulties, the personnel, the people involved. Then you've got aid to Israel, aid to Ukraine. Anne-Marie, that's tough.
It's going to be challenging, Jonathan, when you look at what the president is requesting from Congress when it comes to the national security priorities he outlined. It was aid to Israel, aid to Ukraine, aid to Taiwan, as well as more aid to the U.S. southern border. The issue is, altogether, this is going to be a difficult package for Republicans to sign up on, and even potentially some Democrats. But if you were to take them and sever each individual one, there could be bipartisan support. The problem is, Jonathan, of course, is you have a House that passed an Israel bill that had a pay for that a Democratic Senate will not sign off on. So you talk to people and they say there is a path for this to get done. But as Kayleigh outlined, you know, we just saw Congress this week do the bare minimum, keep the government open. And we're going into the holiday season, and they're going to be up against another deadline of this sort come January.
Can't wait. I know you're both excited. Anne-Marie, Katie Lyons, thank you for the coverage. Appreciate it, as always. About 23 minutes into the session, equities just about positive with some sector price action. Here's Abby.
It may be a small gain right now for the S&P 500, John, but it is a broad gain. The composition sector-wise, most S&P 500 sectors are higher, 8 to be exact, led by utilities up 0.5%. The dividends of those companies look more attractive with yields down today. Tech also up about the same amount to the downside. Energy falling in sympathy with oil, which is down right now by about 2.5%. If we take a look at what is happening for China Tech and also the NYSE FANG index, we've got some weakness. The China Tech index is down 2.4%. The NYSE FANG index off of its lows, but nonetheless down. And Alibaba, the worst day since October, as you were talking about earlier, after nixing that cloud spinoff.
A tough day for that stock, that's for sure. Abby, thanks for the update. Appreciate it. Up next on the program, we'll take another look at the calendar going into the weekend.
Maybe I should go do something else. I can't do anything better than I'm already doing. I already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
26 minutes into the session. Equities doing okay, positive by 0.2% on the S&P. Let's get you the schedule going into the weekend. It looks a little something like this. President Biden speaking at 1:45 p.m. Eastern Time from the APEC Summit. More retail earnings with the Gap reporting after the closing bell. On to Friday, Fed speak from Collins, Barr, Daly and Goolsby. And we finish up with some U.S. housing starting data coming up at 8:30 Eastern Time tomorrow. From New York City, thank you for choosing Bloomberg TV. This was the countdown to the open. Good luck for the rest of the trading day. This is Bloomberg.
Are facing some tough challenges. Higher living and education costs and wages that aren't keeping up with inflation are making it harder for them to support themselves. And they're relying more on the bank of mom and dad. A new bank rate report shows nearly 70% of parents with kids 18 and older are putting their own finances in danger to help them. About half are dipping into their emergency savings or delaying paying off debt, while 43% drain their retirement funds. So where do you draw the line? There seems to be a generational gap, as older parents can't understand why being self-sufficient now is a lot harder than it was for them. Gen Z seems to think on average that 22 is a benchmark for covering the expenses, while baby boomers say their adult children should pay their own way closer to age 20. Either way, it's a family decision. Bankrate suggests having a conversation with your kids and setting a specific dollar amount or time frame for footing the bill.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology. Start demonstrating the utility.
Bloomberg Crypto, Tuesdays. This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month. This is Bloomberg Markets with Paul Sweeney and Matt Miller.
Why were the economists so wrong? What are the economists getting wrong? Isn't this a slam dunk time to buy U.S. Treasuries?
Soft landing, hard landing, no landing. I don't know.
True. What the heck does that mean?
I don't know.
Breaking market news and insight from Bloomberg experts.
We're going to be in an environment with higher rates for longer.
The 5-day in-office work week is effectively dead.
It's definitely a good sign that we're not ready to land this economy just yet.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
All right, good Thursday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. Coming up, we're going to check in with Herman Chen. He's the senior analyst at Bloomberg Intelligence following the regional banks. Apparently, the FDIC is putting some more rules on those regional banks after some of the bank uncertainty and concerns from earlier in the year. So we're going to get the latest on that. What does it mean for the banks in the U.S.? And then we're going to check in with the CEO of Precigen Healthcare Company, talk about drug development, including those weight loss drugs that Matt is so fired up about. Nimrit Kang, she's a co-CIO and senior portfolio manager at Northstar Asset Management. She's going to join us, and she's going to give us a couple of stocks that she likes, I think. So that's how we're going to do this first hour here. And let's kick it all off with Nathan Hager with the Bloomberg Business Flash 10 DC.
Starting off with the latest economic indicator just crossing the Bloomberg terminal, Paul. U.S. home builder sentiment has fallen to its lowest level this year. High mortgage rates are keeping a lid on housing demand. The National Association of Home Builders gauge decreased 6 points to 34. Economists surveyed by Bloomberg were expecting 40. As for stocks, they're starting to show signs of life, where a lot of the action this morning has been in the Treasury market after initial jobless claims came in a little higher than expected, showing further signs of cooling in the labor market. Wei Li, chief investment strategist at BlackRock Global, says there is a case to be made for buying into this market, but she says investors will need to be selective.
If you look at U.S. equity market, 17% up for S&P 500, but the mega tech names still account for close to 90% of that performance. Equal weighted S&P is still flat on the year. And if you look at multiples, actually 72% of the U.S. equity market are trading at multiples lower versus the pre-pandemic level.
And you can hear more from Wei Li of BlackRock on the Bloomberg Surveillance Podcast. Right now, the S&P 500 is up 7 points, or 0.2%, 4510. So we're trading above 4,500 again at the S&P. Dow Jones Industrial Average is little changed at 34,991. The NASDAQ is up 14 points, or 0.1%, 14,120 is the NASDAQ level. 10-year Treasury is up 22 30 seconds now for a yield down to 4.44%. The yield on the 2-year is at 4.83%. NYMEX crude way down 4%, $73.61. Now gets you a barrel of West Texas Intermediate. COMEX gold is up almost 1% at $19.83 even per ounce. The euro 1.0881 against the dollar, and the yen is at 150.55. That's a Bloomberg Business Flash. Bloomberg Markets is on now with Paul Sweeney and Matt Miller.
Nathan Hager, thank you so much. We appreciate that. Matt Miller and Paul Sweeney live here in our Bloomberg Interactive Brokers studio, streaming live on YouTube as well. So just head over to youtube.com/ or search for Bloomberg Radio. So, Matt, I need a quick beard update. It's still there.
It's still, so the idea is, yesterday my beard maybe was a little bit too long. I want to get a check from management as to what they think. Either trimmed down, which is today, or tomorrow I'll just go fully clean.
Really?
And then I'll just hand it off to, the powers that be to dictate how my face should look.
All right, so this is coming from senior manager. They're having discussions as we speak about this.
Well, TV is a visual medium, so we need to look our best.
Okay.
And I don't really know. Do you think beard or no beard?
No beard.
You're a no beard guy. Okay. But my wife says beard. So.
All right. Well, we'll play it by ear. I'll talk to a couple people here on the 5th floor and see if I can.
Let's ask Semenova.
Semenova?
Well, actually, she's never seen me without a beard.
Yeah, I think beard though. Plus, isn't it No Shave November, or is it? That's always the case for you.
Good point.
You're just adhering to traditions.
We're
so
smack in the middle of Movember.
That's right. That used to be a thing. Alex Semenova joins us. She's a Bloomberg News equities reporter. Alex, we got kind of a mixed screen here. A little bit of red, a little bit of green. What are you looking at?
Yeah, lots going on today. Lots of names that we're watching. But I will start with Starbucks. Thousands of baristas at hundreds of Starbucks stores are going on strike. They'll be protesting the lack of their first contract despite 2 years of fighting for one. The strike at Starbucks, which some have called the Red Cup Rebellion, named after their reusable cups that they give out for the holiday season. They're going on strike for only a day, unlike recent strikes that we've seen with the United Auto Workers Union and the Writers Guild of America, which shut down productions entirely of many movies and television shows. Shares are still up about 1% today, so not a big move there, given that it's only one day likely, but still worth highlighting that lots of organizing going on among these labor unions.
Exactly. And when I walk into the average Starbucks, it seems like they work really hard. It seems like they're always, I'm not going to say understaffed, but man, are they barely staffed well enough, because these people are just doing a million different things.
They're just churning out drink after drink.
Well, at the Starbucks here, I mean, there's barely enough room to put any more employees, you know?
The one on Lex?
The one right on Lex between 57th and 58th.
Right.
Now, there used to be one here in this building.
Why? I don't know why, because we have like 5,000 types of coffee here in Bloomberg.
No, but we also have 5,000 people working in this building who don't want whatever we're serving on 6. They want, look, a lot of people want the Starbucks taste. Now, there are some coffee connoisseurs who don't like it. They think it's burnt. But there are some people.
I'm one of them. I'm not a.
You don't like it?
No, I'm a big coffee snob.
That's good, because apparently Starbucks is basic. Alex.
Yeah, it is. I'm not basic. I like some of the local coffee shops. I don't like, not a big Starbucks.
But some people, and I get, some people say, look, I want my coffee to taste the same whether I get it in Seattle, in New York, in Berlin, in Beijing, and those people are going to go to Starbucks. They like consistency. Exactly. Thank you.
Gina Martin Adams, Bloomberg Intelligence, one of the smarter folks we have on this program. She walks 3 or 4 blocks to Joe and the Juice. She won't go to. I mean, that's how crazy she is.
But
and
because she has juice, or they have coffee there? I don't know what Joe and the Juice is.
The thing about Joe and the Juice is their sandwiches are the thing that they're known for. I don't know why they don't do a rebrand. Such a weird name for a place.
Private equity
specializes
Private
in
equity
sandwiches.
just bought Joe and the Juice like yesterday or the day before.
Yeah, I know. It's a big deal. But I go in there and I think, is this a juice store? Do I really want juice? That's going to send my glucose levels through the roof, right? And then what else? Like, if it's a sandwich place, why would it be called the Joe and the Juice?
Yeah, it's weird.
Figure it out. What else
They
you
need
got?
to figure it out. We have to talk,
We
of
learned
course.
something about Alex today. Coffee snob.
There you go. We have to talk about Walmart as well. Of course, shares were down about 7%. That's after the company, which is a consumer bellwether, struck a cautious tone about the outlook for U.S. shopper. They cited some weakness at the end of October. It did modestly raise its annual profit forecast, but that wasn't enough to offset those investor concerns about the consumer. And we've seen rates stabilize. There's this view that the Fed is done hiking, and a lot of strategists I speak to say that the next thing to watch out for is what consumers will do and whether they'll continue to have, staying power.
And I mean, I don't know. It just seems to me no company really has a better sense of what the U.S. consumer is doing than Walmart.
Exactly.
I mean, the #1 grocery chain in America, which I didn't know until a couple of years ago when Jen Bartashis from Bloomberg Intelligence told me. Plus, they sell everything else.
You didn't know that it was a grocery story.
Yes, exactly, exactly.
It's pretty fascinating to me that Walmart's down 7% today. I mean, that's a big drop for such a big company, right?
Yeah.
And meanwhile, Target was up 18% yesterday.
Yep. So I mean, if you're a hedge fund and you own Walmart, it's one of your positions. You're buying some stock today. That's your core position. You trade around it. You get the days when it's down 5, 6, 7%. You add a little bit more. When it's up 5, 6, 7%, you trim a little bit, and you just kind of trade around your core position.
By the way, I always take a 5-year look at all these stocks. I have for 20 years because the comp function defaults to that, and I think it's a good way to look at a reasonably long-term investment. I put up Target versus Walmart. Before yesterday, Target had been trailing. Total return over the last 5 years was a little more than 50% for Target, and it was more than 75%, more than 80% for Walmart. Now, because of what happened yesterday at Target and today, Target's ahead. Target's up 85% over the past 5 years, and Walmart is up only 76%.
All right. So
Interesting.
still
I'm
making
interested
money.
to see the divergences that we've seen first in tech, now among retailers. A lot of investors really getting more selective.
Yep, and next week, I guess the big name is NVIDIA, so we'll be on the outlook for that. All right, Alex Semenova, thank you so much for joining us. Alex is the reporter covering all the markets for Bloomberg News. She joins us live here, and we appreciate getting some updates there on some of the names moving. All right, Herman Chan's in here, and he covers the regional banks for Bloomberg Intelligence. I don't know why he's in here. I don't know why we got to talk to this guy, but Herman, what's happening with the regional banks? Because I feel like a huge shoe is about to drop in terms of, I don't know, commercial real estate loans, just higher rates, credit card stuff. Give us a sense of what's happening with the regional banks, and is the FDIC concerned?
Right. So the sentiment for regional banks has been poor since March and April after the failures of SVB and Signature, First Republic, and shares haven't really rebounded since that time. There's been concerns on...
Which you told us was probably going to happen. They
Right.
were not going to rebound because this
Right.
is a long-term earnings
We're facing a longer-term earning issue from margins because of
Yep.
higher funding costs and higher interest rates. Banks aren't lending that much because they're focused on building capital because of tougher capital rules. And then you mentioned commercial real estate and office CRE, a potential shoe to drop there potentially next year with higher loan losses. So the sentiment has been poor, but also you've seen a bid recently over the past couple of weeks as inflation pressures seem to be easing. So the thought of interest rate cuts are positive for banks. And actually, the regionals have rebounded about 15% since their lows earlier in October.
I look at M&T Bank as my proxy. I know that I know there's an ETF out there that is probably much better, but I just like looking at M&T. It's a quality regional bank, up 14% off of that low back in late October.
That's right. So there is a bit of an inverse relationship with longer-term Treasury yields and regional bank stocks. So that's something to look out for. In terms of the FDIC, the organization is expected to vote on a special assessment to replenish their deposit insurance fund, which was hit from the bank failures earlier in the year. So the largest banks in the United States are set to have a hit in the fourth quarter in terms of expenses.
Like JP Morgan's got to pay for the regional banks?
Yeah.
And by the way, was it an industry-wide problem, or were the managers at SVB Group just asleep at the wheel?
SVB was a bit asleep at the wheel. I would concede that.
They were passed out cold, right? Blood alcohol content, like 4.
Not really focused on interest rate risk at that.
Well, why would you focus on interest rate risk as the head of a bank, right? Who cares about that? And now Jamie Dimon has to pay the tab.
Right.
He must be very unhappy about that.
The surviving banks are paying for the sins of the guys that had the failed institutions. So it is how the industry works, for better or for worse.
No, really? You think SVB Group would bail out JP Morgan?
Well, M&T, like Paul said, is bailing out SVB as well. So everybody has to pay their fair share.
Full disclosure, Herman Chan loves M&T.
Well, he used to work there.
Yes.
Yes.
In investor relations?
That's right.
And you're a proud mid-market kind of regional bank.
I mean, I bank at the Huntington
sure you
in Columbus, Ohio.
Who doesn't?
Huge fan. Look, because as a local, I've grown up there. Generations of my family have banked there. So,
The Miller name carries some weight there.
Well, or the benefit is when times are tough, they work with us. You know, whereas a bigger bank would say, "We'll see you later, sayonara," right?
Sure.
Huntington will stick with us and work with us because that's just how more localized banks work.
So, but there are 4,000 of these regional community banks out there. If I put my M&A hat on there, I feel like that's an industry ripe for consolidation.
Right.
Is that in fact the case? And if so, what would be the catalyst?
Yeah, the regionals have talked about M&A being a factor later on, but not quite over the next 1 year time horizon. You have to remember that higher interest rates are a factor, and when banks do M&A, they have to mark to market the target's balance sheet. So, and marking to market means that they have to set the current value on both the loans and assets and deposits, and that can create a hole in the acquirer's balance sheet. So they're waiting for maybe rates to come down a bit so they don't have this tangible book value hits. The second factor is that regulation is still up in the air. The Biden administration has been a bit reticent for bank M&A despite some of the pressures earlier in the year. That seems to be easing, but there's still a lot of questions on that front.
All right, so the commercial real estate, how big of an issue is that for the banks? And when will we see it, I guess?
By the way, you know where the phrase "waiting for the other shoe to drop" comes from?
No, but you told me.
It's because back in the days when New York City was filled with these tenements, the walls and the ceilings and floors were so thin that you could hear when somebody would come home from work and take off his shoes.
Okay.
So you knew when one dropped, you were about to hear the next shoe drop.
Okay, very good.
Oh, you learn something new every day.
I think it's great that it's tied to real estate, right?
Right.
Because the next shoe to drop is also tied to real estate.
Yeah, that's true. In terms of commercial real estate, it creates more headline risk, in my view, than actual potential losses for at least the regional banks that I cover. We're talking about 2 to 4 or 5% of their total loan portfolio is tied to office commercial real estate.
Who owns that stuff then?
It could be smaller regionals. It could be securitized CMBS.
Because I'm thinking about
insurance.
I'm going to go back to my lipstick building on 3rd Avenue and 54th Street here in Manhattan.
Right.
At some point, that thing's going to reprice, and it's going to reprice at a big discount, and the equity is going to come out of that thing, and whoever's got the mortgage against that is going to have to do something.
Yeah, you're going to have to take a big hit on that.
I just wonder who owns like those kinds of commercial real estate mortgages.
My brother, by the way, works in the lipstick building.
It's such a cool building.
Yeah.
I think it's awesome.
Yeah.
I think
So
Bernie
hopefully they
Madoff
do
used
okay.
to be there as well.
Oh, yeah?
Yeah. But
Bernie Madoff was there.
Yeah. So it is a headline issue, but I do think it's going to be manageable. But you will inevitably see losses for the regional banks, and they are already booking reserves against potential losses expected over the next few years.
All right. So, but if I'm looking at M&T Bank, I mean, so when do I say the earnings risk is behind this industry? I'm looking at the next year's numbers. It's not then. I mean, they're still going down.
Right.
I guess in 2025 is when you expect earnings to rebound for this sector?
Yeah, I think we've written a note actually today on net interest margins potentially stabilizing, and for most of the banks that I covered, will happen by the first quarter of next year if interest rates even stay where they are today. So that's positive. You're not getting any benefit from loan growth, though, so that's an issue. There's sticker shock in terms of how interest rates are for both commercial borrowers and retail customers as well. So that's going to be a factor for the foreseeable future. But in terms of net interest margins, that stabilization will help reduce some of the pressures on NII, net interest income, for the regionals.
All right, man. Herman Chan, you're the man. You cover all the regional banks for Bloomberg Intelligence. We appreciate getting a few minutes of your time coming here in our Bloomberg Interactive Brokers studio here. Still a little bit of headwinds there for the regional banks. But again, I'm looking at some of these earnings estimates out there. They start turning really noticeably positive in terms of growth rates in 2025 for some of the regional banks. So who knows? That could be an interesting area. This is Bloomberg. Let's get some company news right now with Lisa Mateo.
You got it, Paul. Macy's reported third quarter profit that beat expectations thanks to better inventory management. But same-store sales fell once again. Bloomberg's Katie Greifeld has the breakdown.
You saw adjusted earnings per share come in at 21 cents. That is well above the average analyst estimate of 0 cents. So again, a beat there. You also saw gross margin come in just above 40% thanks to fewer product promotions. And an interesting wrinkle in this report was the drop that you saw in same-store sales, a third straight quarter actually of declines.
Now that doesn't seem to have investors worry too much. Macy's right now, it's up about 7%. Walmart lifted its profit forecast, but just modestly, and this after signs of weakness at the end of October. And that has shares lower, down about 7%. Bloomberg's Abigail Doolittle has more.
Now, it did rebound apparently in the beginning of November, but they're talking about that around the holidays. So they're kind of cautious here on the consumer. They're saying specifically that we are more cautious on the consumer than they were just 90 days ago at this time. Also making this super interesting, at least to me, Target said something very similar yesterday, but Target going into their print yesterday, and it was a blowout in terms of adjusted earnings. That's not the case here for Walmart.